It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Tuesday, October 15th, and welcome to Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. Let's get to the three things that you need to know this morning.
Good morning, everyone. First up, U.S. stock futures are flat after the major averages hit fresh records on Monday. The S&P 500 and the Dow reaching new highs, led by a rally in technology stocks. Now investors turning to earnings as the next driver for the market rally. Reports out this morning show trading revenue and deal making at Bank of America and Goldman Sachs led the banks to top earnings estimates. Meanwhile, results from UnitedHealth saw the insurance giants lower the top end of its forecast, while the pharmacy chain Walgreens, they beat quarterly estimates, but announcing plans to shutter 14% of its stores. And now, well, investors are looking to United Airlines after the bell Tuesday for the latest read on the health of corporate America.
Plus, all eyes on chips after Nvidia and TSMC hit record highs. Nvidia's rally bringing the company closer to the title of the world's most valuable firm. But shares moving lower today on a Bloomberg report that the Biden administration will cap Nvidia's AI chip sales to some countries. People familiar with the matter saying that the new framework would set a ceiling on export licenses for Middle Eastern countries looking to expand in AI data centers.
And we'll hone in on the commodities space. Oil prices plunging after a report from the Washington Post that Israel may avoid targeting Iran's crude infrastructure. Investors' concerns of a supply crunch easing after the report. But new data from the International Energy Agency show geopolitical risks to oil output in the Middle East are being offset by a potential glut in supply.
Earnings season gaining steam today with results from big banks. Bank of America, Citigroup, Goldman Sachs, all reporting before the bell this morning. Bank of America beating profit estimates on strength in investment banking and trading, but profits still taking a hit from rising deposit costs. Citigroup beating expectations following growth in investment banking and wealth management. And Goldman Sachs also reporting a beat. There's a theme here with third quarter profit up 45% from a year ago, boosted by strength in investment banking. Joining us now, we want to bring in Nathan Stovall. He is S&P Global Market Intelligence Director of Financial Institutions Research. Nathan, it's great to have you there. So I rattled through some of the headlines here that we're getting from the reports that were out this morning. The overall theme to me seems to be that the overall theme right now is improving for banks. Where are we in this recovery? And what was your biggest takeaway from the reports we got this morning?
I think that's right. I mean, there's lots of positive things to see in here. Whether you look at the investment banking piece that you alluded to, not only is that positive from an earnings perspective, but I think it speaks to increased risk appetite among corporates. You know, banks are thermometers of their economies. And when you talk about the big market folks like the Goldmans and the Citis and the B of A's of the world, we're actually seeing their corporate clients willing to take a little bit more risk, pursue more deals, stronger in particular on things like debt underwriting. But the other thing I really point to is heading into this quarter, the big question was going to be on credit. And were we going to see real cracks in the armor? And we haven't. I mean, really haven't seen any real deterioration, both from the commercial lending segments or the consumer lending segments. So a lot of holding up and signs of pointing to either a soft landing or almost a no landing scenario, which is very encouraging for the U.S. economy and certainly bank stocks.
And Nate, so as we think about some of the kind of checklist items that investors need to be keeping in mind, of course, investment banking, one piece of that is across all of the banks that's been incredibly important. And one of the kind of bigger nods that we had seen came out from Citigroup here this morning, investment banking revenue up 31%. One of the other checklist items for us was net interest income. And what are you seeing more broadly across the board here from the banks that have reported so far?
Sure. Well, there's sort of two pieces to that. One being, when are we going to see funding pressures ease? We haven't really kind of seen that yet. We are still seeing deposit costs migrate higher, and that's been the real impact of higher rates and higher cost funds continuing to turn over on bank balance sheets. And the real question is going to be, when do we get that relief? We didn't expect we would see that really show up in Q3 results because we haven't seen rates come down on deposits until the last few weeks of the quarter. The good news there is we're seeing improved guidance from the banks that have reported, And from the calls we've heard, we're hearing that the customer's not pushing as much for higher yielding accounts. So that's positive for net interest income and net interest margins, more looking into Q4 and into next year. On the broader piece, on the volume side, deposit balances are holding up okay. We've seen sort of a mixed bag there, some pressure and some that have reported some growth in others. Loan side, you've actually seen modest growth there, but we've actually seen some encouraging prints from both PNC and B of A. So as I said, it's a bit of a mixed bag, but I think the picture is getting a little bit better. And if you think about where we were starting heading into this quarter, there was a lot of fear there of how ugly that could get and whether or not there would be improvement soon. And I think these banks are guiding that we are going to see better days ahead there.
So then what does that improvement look like as you look out into 2025? It sounds like you're encouraged here by what that picture is going to look like. And then going back to what your comments just were on net interest income, does that really point to the fact that this story is likely to be complicated here for the quarters to come?
I think that's really well said. It is going to be complicated because it's not so much that we're going to get a lot of growth or that things are going to get a lot better. It's more that they're better than what expectations were. And that's one of the weird things about this quarter in particular is that it's not that it's this barn burner of a quarter. It's that heading into the quarter, expectations were not great. The street was really, really worried, and uncertainty was very much weighing on the group, not only from a net interest income and a margin, but certainly from a credit perspective. And the fact that you aren't seeing a lot of negativity come out of the banks that have reported, I think is one of the reasons you saw a rally on Friday and that the stocks are holding up. And I wouldn't be surprised if you saw continued strength after the prints today.
And then, since you already hit on one of our other checklist items in deposits and acknowledge that and the importance there for that being a common denominator across all of these banks, perhaps a bonus checklist item or perhaps a sub checklist item, if you will, is the wealth management divisions at these banks here and the assets under management. We've, of course, heard from Goldman Sachs and even Charles Schwab and some of the year-to-date record flows into their wealth advisory business as well. What do you think is driving that right now, and how does that kind of pass through to how investors should be thinking about the businesses with the strongest wealth management pitches?
Sure. Well, the fact that AUM is holding up, and Schwab's a great example where you actually saw cash sweep balances come in way ahead of expectations, I think points to strength in consumer and strength in the retail investor base. And that has to be another good sign for the broader economy and, of course, banks, wealth management businesses. Certainly the fact that markets have been healthy support those businesses as well. But ultimately, the fact that you're seeing balances continue to increase is a good thing. It speaks to more risk on rather than risk off in my mind. So my takeaway there is it just kind of fits with this broader narrative we're seeing of slightly better than we thought in all of the components in terms of health of the consumer and health of corporates.
Nathan, what bank are you most worried about right now?
I don't know if I have a single bank that I'm most worried about, but I would say broadly, the question we get all the time remains around commercial real estate and those banks that have elevated exposure to commercial real estate. And that's going to be more focused on the regionals. But one of the things we continue to point out is that there needs to be more nuance in discussion and not all commercial real estate portfolios are office. One thing that I have taken from the early results on office, though, is you continue to see massive reserves there from the banks that are providing detailed disclosures, but they're not going up all that much. So what I really want to see from the banks with really elevated exposures there is, are we going to see more deterioration in those loan portfolios? We've seen modest increases in delinquencies, modest increases in reserves. And my question is, if there is an outlier there, if you see somebody go away from that trend, that's who I would really be worried about. But we haven't really seen that. I'm not going to say that we're going to get through this with everybody getting it right. It's certainly possible that somebody won't. But that's really what I'm looking for. Who's going to break away from the trend, because it's certainly possible that somebody will.
Nathan, real quick, before we let you go, just where are we in the commercial real estate cycle right now? Has the market stabilized in your view?
So it's this weird dichotomy where I think pricing is starting to stabilize. One of the things we look at is the publicly traded REITs, because they trade every day, and that you've got some folks that are focused on single asset classes, and They took quite a beating, over the last 2 years, but you are seeing stabilization there, but you're still not seeing much price discovery in terms of transaction activity. So if you look at that as a proxy, maybe we're getting closer there in terms of prices, but we just think that ultimately this takes a lot longer than many people think, because the banks, while they're getting very intense scrutiny from the regulators and their investors, they're not being forced to purge these portfolios. There's incremental pruning from them, but we don't think you're going to see big ways of purging anytime soon. That might pick up if you see more bank M&A activity, and we do think that that's going to be on the horizon, more of a 25 event. But ultimately, it's going to take longer. We do think maturities are going to drive some activity, and we've estimated it's going to be $950 billion in CRE loans maturing this year, but a lot of that could be extended out. So again, just this idea that it's not going to come all at once, and it's going to play out over the next few years, quite honestly. So it's not going to be as quick as some people think, but we are starting to see some stability in the few pricing metrics that we have out there, which is encouraging.
Nathan Stovall, who is the S&P Global Market Intelligence Director of Financial Institutions Research. Nathan, great to have you back on the program.
Thanks.
A promising start to the third quarter earnings season, with big bank earnings continuing to beat some of the Wall Street expectations this morning. Futures, they're remaining pretty steady here, mixed right now, with inside of 20 minutes until the opening bell. And this is after the Dow and the S&P 500 averages hit fresh records Monday. So just how much upside left is there in this market? Here with this insights, we've got John Stoltzfus, who's the Oppenheimer Chief Investment Strategist. John, great to have you here, and thanks for kind of joining us here ahead of the opening bell. So let's just start there. Do you think there is momentum, and how does that kind of play out?
Well, great to be on Yahoo Finance today with you. I would have to say we think there's more upside here. Not necessarily in a straight line. We can't help but think with the 46th record high for the year for the S&P 500. As things tick up, we'll have to rely a lot on a continuation of improved earnings or better than expected earnings in a quarter where a lot of the street was looking for lower earnings versus the prior quarter. Let's see how that develops.
John, when it comes to what investors are going to be looking for, hints within this earnings season to really carry on that momentum, how much of that is going to be placed on guidance? And I guess more specifically, what is it that investors need to hear in order to give that confidence that there is still momentum here to the upside?
Well, Shauna, I think it's a combination of a number of things. The first thing is the guidance, of course, quite important in terms of the sentiment. But I think even more important are where are the positive surprises, and we've seen it with the big banks where they cross the transom with better than expected results, and the banks most certainly, each bank showing their particular strengths and their particular weaknesses in the process, but generally showing that things better than expected. And then, of course, tech earnings have been excellent so far. In terms of what we've seen. But remember, only of all the S&P 500, I think it's only about 8% of the companies have reported, so we still got to watch. But we do think our 5,900 target that we put in July, remember we came in here at 5,200 as of last December, we put in for this year at 5,200 target. We had to raise it in March to 5,500. In July, we went to 5,900. So we're eagerly watching the market to see if we're going to cross the transom and close at or above 5,900 over the course of the next few days. That said, you can't help but think when you keep posting record levels for the S&P, there's always the potential for some kind of a catalyst to cause people to take some profits without FOMO. But that said, all looks really, as Larry David would say, pretty good.
Very good reference there, John. Thanks so much. Even as we're thinking about the earnings growth rate that's been marked to this juncture, or at least by the end of last week for the S&P 500 companies, we were sitting, according to FactSet, at about 4.1%. What are you modeling for in a real earnings growth rate, and do we need to exceed that in order to see some of those new all-time highs that you're also projecting for?
Yeah, we'd hope that in this quarter we could beat that 4+5% earnings growth as we have seen in prior quarters this year, particularly in the first and second quarters. So we would hope that we might be able to hit 7% earnings growth here, a little bit less than last. Because the comps get tougher as we go forward here. Remember, fourth quarter, as I recall, was much better than expected. Then first quarter this year, second quarter better than expected. So this might be a little bit wonky, but it's very early to tell. And tech is an area where a lot of people were expecting trouble. And thus far, tech is looking pretty good. And tech is, in terms of performance, in terms of the sectors, is in the lead.
Yeah, and John, given that and given where Nvidia sits, we had a record high yesterday. We're seeing a bit of a pullback today. But given that I guess, how sustainable do you see that momentum within tech specifically? What does that really tell us just about the overall makeup structure right now of this bull market?
I've got to say, Shauna, that when we look at it, we think the reality is we're not going back to the slide rule or the abacus or abacus, however people want to pronounce it. It's a world of chips. It's a world where both the consumer and business have technology deeply embedded in their lives. AI in an innovation cycle that we are now in, likely to cause upgrades across the board of the technology that we use at home as well as in the office. So tech to us looks likely that it may share the center stage position at points here in earnings cycles going forward with other sectors as other sectors benefit from technology advancements and become more efficient. But we don't think tech is going to take a back seat at this point, because we don't see technology approaching essentially a level where it stalls in terms of innovation. This doesn't look anything like when we had the tech bubble, it was very different, almost primitive compared to where we are today.
All right, John, it's always great to have you, especially here to kick off the top of the hour with us. John Stoltzfus, he is Oppenheimer's Chief Investment Strategist. Thanks so much for taking the time to join us. Coming up, we'll bring you continued earnings coverage ahead and dive into the healthcare names reporting this morning. You see them up there on your screen. Plus, we'll count you down to the market open as stocks trade in the green after closing out a new record high. You got the Dow futures pulling back just a bit, and we will bring you the latest on commodities. Oil prices pulling back here this morning on supply as supply concerns ease. We got all that and more on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's get to those chip makers here. The U.S. is considering a cap on AI chip exports to certain countries. It would set a ceiling on export licenses for Nvidia, AMD, and other American chip companies. The Biden administration has already restricted shipments to more than 40 countries across the Middle East, Africa, and Asia over fears that their products could be diverted to China.
Meanwhile, EV chipmaker Wolfspeed is set to receive $750 million in federal grants from the CHIPS Act for its factory expansion plans in North Carolina and New York. It's part of a more than $6 billion expansion that's estimated to create about 2,000 manufacturing jobs. And this, of course, on the heels of other grants that have been granted here from the Biden administration. But more specifically, what this means for Wolfspeed, what it means for the industry here going forward, and where the U.S. stands within some of that competition. Wolfspeed's CEO saying that the United States currently produces 70% of the world's silicon carbide, and that this investment is going to help the U.S. preserve its lead against China.
And for those out there who are wondering what the heck is silicon carbide, I'm glad you asked here. It's essentially a superior alternative to silicon for some of those high power applications, as said by Wolfspeed: EV powertrains, e-mobility, renewable energy systems, battery energy storage systems. Oh yeah, and for all the AI and cryptocurrency fans out there, yeah, it's used in those data centers. And so it's supposed to give this improved performance plus lower system costs as well, which is why it's so highly touted.
And now we all know. A quick little lesson from Bradley. All right, let's stick with the chips and talk about Nvidia, because Nvidia right now coming off a fresh record high. You can see in the pre-market, at least, off just about 0.7%. Yahoo Finance's Jared Blickery is here with a breakdown of what the technicals are telling us. Jared.
Thank you, Shauna. Indeed, we did get that record closing high yesterday. Still don't have a record intraday high, but I wanted to show you what's happened over the last month. We've got this really nice liftoff since basically the end of September, but we're still within a very large trading range. And this goes back 5 or 6 months, depending on how you slice and dice it, but we are right there back at the Rubicon. I would strongly suspect that we managed to get another intraday high. But record high. But the question is, are we going to have a false breakout? Because that's on a lot of traders' minds. It's something that really hasn't happened with Nvidia in a long time. Happens with Bitcoin all the time. But it's a possibility. So if I put a 3-year chart on, we can see that there have been several instances of consolidation. In 2023, that was 6 or 7 months, the entire back half of the year. It didn't take off again until 2024. So we've seen this before, and traders are just trying to ascertain, all right, are we going to be able to punch through and maintain that momentum? Well, things are looking pretty good for some of the broader indices here. I'm going to show you the NASDAQ 100, and here's the NASDAQ 100 year to date. It's not quite at a record high just yet, but here's the NASDAQ 100 equal weight. It just notched a record high yesterday, along with the S&P 500 equal weight. So my point is, we have a lot of momentum to the upside and a lot of breadth. I think it would be uncharacteristic to have Nvidia sucker traders in only to have it go down, but we have seen that happen before. And I guess the difference being that Nvidia has always resolved to the upside. So eventually there's going to be a fake out that kind of catches traders. But you did mention in the intro that Nvidia is about to overtake Apple. And I just wanted to show those numbers for you. I'm going to put market cap. This is the NASDAQ 100. Here's Apple, $3.516 trillion. And here's Nvidia sitting at 3.386 trillion. Guys?
All right, Yahoo Finance's own Jared Blickery. Jared, thanks so much. Appreciate the technical breakdown there on NVDA. Finally, let's talk a little healthcare stocks on the day. UnitedHealth and Walgreens reporting their earnings this morning. UnitedHealth beating third quarter earnings estimates, but lowering its full year profit guidance, hit by higher than expected medical costs and the impact of a cyber attack. Meanwhile, Walgreens topped estimates and announced plans to close 1,200 stores by 2027. It's part of its ongoing effort to cut costs here. You're seeing shares moving higher here, and perhaps with these cost-cutting measures in mind, investors really trying to price in how they're going to better deliver a retail store experience as well, and perhaps remove some of the unprofitability out of the system at the same time.
Yeah, let's start with UnitedHealth just because of the significance of the decline that we're seeing here this morning. In pre-market, it's off just about 9%. I believe if this holds, we will be on track for the biggest intraday drop that we have seen within the stock in quite some time, going back a couple of years here. Right around 9%, that current decline in pre-market trading holds. It will be set for the biggest fall that we've seen since March 18th of 2020. So I think that really illustrates, obviously, the disappointment from the street. I was going through the quick analyst reaction here to this note, and a lot of it surrounding the medical expenses, the fact that they were higher than expected in the third quarter. The analyst from Baird talking about the fact that the medical loss ratio misses the main story as it prompts more questions than answers. So, of course, that is going to be a focus here on this earnings call that's underway. And then, of course, as you look ahead and into next year. And then we flip over and take a look at Walgreens. I think the big question here is what exactly the future looks like for this company. Obviously, a massive underperformer since the start of the year. It was scrambling to figure out what is going to stick or what is going to work. Yes, we are seeing at least some encouragement, if you could call it that, with shares up 6% here in the pre-market, but still below $10 a share. You can see that steady decline. It's lost about 65% of its value here so far this year. It's closing the percentage of the stores that you went through there just about 14% as it tries to cut costs. But I think investors still want to see more on that front, and there's lots of questions right now as to exactly what that turnaround strategy is going to look like.
Yeah, absolutely. You know, just for some context, as we continue to move through the rest of the healthcare industry reports that are expected this earnings season, according to FactSet, there was an expectation coming into this that you would ultimately see healthcare be one of the 9 of 11 sectors reporting positive or expected to report year-over-year earnings growth, and one of the more outsized moves to the upside as well. Information technology, communication services, and then healthcare sectors were really the top three coming into the start of this, and healthcare for itself was expected to deliver, I think it was just over about 10% in earnings growth here. So actually 10% right on the dot. So all these things considered, not the best start, at least for some of these early names.
Not the best start. We also have Johnson & Johnson out this morning. We will be speaking with an industry analyst coming up next hour, getting his insights on Johnson & Johnson specifically, but also his commentary overall about where healthcare stands, given the fact that we're getting a first look here at third quarter results. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. You're watching Morning Brief. Just about 20 seconds until the opening bell on Wall Street, again coming off of record highs as we kick off a brand new trading day. The S&P on track to open the day with gains, pushing above that 5,900 level. We will see whether or not that holds as we push ahead for today. NASDAQ 100 futures also moving to the upside. Dow futures, the laggard here as we start today's trading day. Again, a big question for investors. We're getting another look at earnings out this morning, especially some of those big bank results. Citi, Morgan Stanley, Goldman Sachs, among the names are reporting this morning. Lots of questions about what exactly that tells us about the movement here going forward. So again, a couple of names to keep in mind. And this report brought to you by Invesco here. Let's take a look at the major averages here. Again, like I mentioned, you've got the Dow under just a bit of pressure, off just about 0.2%. But again, the S&P once again pushing higher here this morning, getting it closer and closer to that 5,900 level. You also have the NASDAQ holding on to gains. Lots of action that we want to take a look at within the commodities market. We saw that starting to trickle through the markets last night. You have crude pulling back off nearly 5% here, holding just above $70 a barrel. There was a report out that Israel was not going to strike Iran's oil facilities. That, of course, easing some of the supply concerns that have been built up into the market here over the last couple of weeks. So we're seeing a pullback here in crude. And flipping over to that sector action and give us a better picture of the action that we're seeing today. You've got financials on the heels of the stronger bank results. That's moving to the upside here this morning, followed by real estate and utilities. On the flip side, you've got healthcare, energy, and materials all trading just below the flat line. Taking a look inside the NASDAQ, lots of focus on some of those bigger cap tech names here, especially Nvidia. You got Nvidia pulling back from its record close yesterday, off just about 0.2%. Not a huge move here, but you can see just over the last 5 days had gained some momentum, up just about 3%. And of course, taking its year-to-date gains, again, staggering here as we talk about its outsized impact on the market's gains since the start of the year, with Nvidia shares up just about 178%. Outside of Nvidia, you are actually looking at gains here. Some of those other larger cap tech names, you got Apple, Google, and Microsoft holding on to gains. You've also got Tesla up just about 1.3% here today, Brad.
All right, thanks so much, Shauna. U.S. stocks rallying for a fifth week and touching new highs. But are investors pricing in the risk of an economic slowdown? Our next guest thinks that growth concerns are the biggest risk for stocks. Joining us now, we've got Tom Essay, Sevens Report Research founder and president here. And so break down your thesis just a little bit more for us here. And if we were to see some of that volatility stemming from the catalyst that you suggested the markets are not pricing in, what type of volatility could that imply?
Good morning, guys. Thank you very much for having me on. Yeah, I think the market is complacent to growth risks. I mean, the S&P 500, as Shauna said, is about to break 5,900 and may do it here while we're on the air. And at those valuations, it's essentially priced for perfection. It's priced for an ongoing soft landing, no economic slowdown, stable earnings, no deterioration in geopolitics. What it's not factoring in is that what's happened in the past happens again, whereby higher rates actually slow the economy. And I want everybody to realize that a slowing economy does not necessarily mean a recession. But where stocks are right now, if growth even slows to sort of flat or sub 1%, you could see a 10% drop on the S&P 500, and we wouldn't even be probably at fair value. So, look, things are good right now, but I do think the market is complacent to economic slowdown risks.
So then, Tom, what's your advice for investors? What should they be doing today to prepare themselves potentially for that downside risk?
I have been advocating for focusing on quality and lowering volatility. So we can do that with all the financial tools we have now. You can go to ETFs like a USMV or SPLV or a QUAL. And essentially what this does is it sort of bolsters your portfolio. Sure, if the AI craze carries the NASDAQ another 10% higher, will you lag on the upside? A bit, but you'll still participate. However, if I'm right about the growth fears, then you're not going to fall as hard as the rest of the market.
And so with that in mind, in some of your notes, you also say with rates high, you don't think that growth remains the single biggest risk to this market. What is the more outsized risk then?
Well, I think geopolitics could be probably one of the largest risks out there. I mean, we are not in a good geopolitical state, are we? I mean, we all seem to sort of not we're not focused on it here in the markets because it hasn't really impacted. But it can, and I think that that's a potential wild card that people need to worry about as well. And then also there's going to be a lot of political uncertainty coming out of the election because we're all going to be trying to game what policy changes are going to occur. All of these things can combine to sort of fracture this perfect window we're in the markets. And I'm not saying things aren't great right now, but we are in a pretty good state right now. But all I'm trying to do is remind investors that, hey, there are risks out there, and that this is the stock market can go two directions as well. We only seem to be focused on the up at this point.
And Tom, since you mentioned election there, what do you think volatility is going to look like? We talked a lot about the volatility that we could see here over the next several weeks leading up to the election day. What about right after the election? What do investors need to know?
Yeah, I think that the biggest thing is we look at the election. First of all, the worst case scenario is basically that there is no decision shortly after election day. And I think that investors, all of us as investors, need to hope for clarity, regardless of who you want to win. But if there's no clarity and we sort of get dragged on for weeks where we don't know the outcome, that's the worst case scenario from a volatility standpoint. I think they could easily take 5% or more off this market again because we're so richly valued. On the flip side, if we get one party rule out of the election, whether it's Democrats or Republicans, that's going to spur a ton of policy uncertainty as well. And I know that in the past, markets sort of have this knee-jerk, Republican total control, good because lower taxes and growth, Democrat potentially not as good because potentially higher taxes. That's not the case this year. We have a different dynamic. The deficits and budget matter. And if markets view even one party or the other as blowing out the deficits, that's going to be a negative regardless of whatever will happen with taxes.
Tom, just very quickly here. I mean, the S&P 500, and you're right to point to the kind of historical performance that we have seen during election years, where typically September and October tend to see a little bit of volatility, little chop going into November, and we typically produce some down months consecutively for September and October. We're coming off of the best September in 11 years for the stock market, and now we're seeing new highs in October. So how atypical could this September-October period leading into the election be compared to past election season, and what does that set up for the fervor coming out of that event even?
Well, it's a great point. I think that this year is sort of quite the reverse of what many people expected it to be and what history implies. But that doesn't mean that risks or vulnerabilities have gone away. Mm-hmm. We are entering an election essentially on the pins, right? On all-time highs, investor sentiments through the roof. Everybody thinks the good times are going to last forever. That's not typically the way it works. It leaves the market vulnerable. So we're all conditioned to think of the Santa rally into year end. But look, we are not coming into it in a strong place like we were last year from a valuation standpoint. So just be aware, September and October were good. They're usually bad. We could see volatility in November and December, especially if the election is undecided immediately following.
All right, Tom, great to get your insight here at the Open. Tom Essay, the Sevens of the Sevens Report. Thanks so much for joining us. Let's turn to oil, tumbling today after the Washington Post reported that Israel will not target Iran's crude output. Joining us now, we want to bring in Patrick DeHaan. He's head of petroleum analysis at Gas Buddy. And Patrick, it's great to see you. So yes, we had the report out from the Washington Post that really is moving the markets. But then we also had the supply report yesterday, or demand report, I should say. And that is also, I think, grabbing investors' attention here. What was your big takeaway from the IEA report, and maybe how that sets us up going into the end of the year?
Yeah, certainly a little bit of weakness now creeping back into oil markets after that report. I think the U.S. maybe influenced Israel in avoiding oil infrastructure if they do target Iran. And now we have not only OPEC yesterday, downward revision with their forecast for 2024 and 2025, but now IEA also joining in. And look, there's a lot of economic weakness out there. I mean, the Chinese economy essentially on life support, fiscal stimulus has not worked there. Oil demand being revised down just about everywhere. And with China's economy kind of down for the count and inability to revive it, I think oil prices, you're seeing a sell-off because it represents the reality of potentially Israel not attacking Iran's oil infrastructure, two downward revisions in oil demand forecasts, economic outlooks that are a little bit slow. Look at Germany's economy now tipping into recession. So there's a little bit of weakness out there. And this is the time of year when you tend to see these things happening, when oil demand is going down seasonally. And then you have all of these other things happening at the same time. Oil prices likely will continue struggling here in the weeks ahead.
And so for the typical kind of annexation that we have to the word oil and plummeting and putting those together, anytime you put plummet after something, it feels like, okay, that sounds bad. But the oil price is coming down at a time where there will be more seasonal demand, typically because of travel and whatnot. Is that a net good thing for the inflationary picture?
Well, it certainly is. I think it gives us potential of seeing the U.S. national average falling below $3 a gallon for the first time since 2021. And look at the price of diesel, by the way, which powers much of the American economy, whether it's construction, whether it's purchase of goods, trains, semis. A lot of the biggest commerce uses are diesel, and diesel prices are at their lowest level since 2021 already. So it's very good for the disinflation story. We're getting a little worried last week after Iran launched attacks on Israel. Oil prices quickly jumped $10 a barrel, but they've given up just about 80% to 90% of those gains now as we come back down. And I think there is the potential that the national average could dip below that $3 a gallon mark potentially before Election Day. And keep in mind, a lot of voters are very aware of what gas prices are. In fact, even Georgia issuing another gas tax holiday. It's very timely here as Americans head to the polls that gas prices are declining.
And so with all of this in mind, the EIA is seeing a sizable surplus, they called it, in the oil market. And so with that in mind, how do you expect that to really play out over an extended period of time, even for the advanced purchase orders, if we do have a sizable surplus like the IEA is expecting?
Well, I think it's going to put more downward pressure on oil. Look at the month ahead contract as well. There's a lot of backwardation happening because there is the promise still of OPEC restoring some of its oil production. And that is a conversation that we'll probably see come into the limelight here in the weeks ahead as we move towards OPEC's annual meeting. Whether or not they restore that production, at what clip? Will the economic weakness persist? Will the U.S. economy kind of be the bellwether for the global economy? There's a lot to discuss, but I think the overall future of oil prices is a bit of weakness. Now, depending on the election, too. And keep in mind, there are some political issues that could get things going. Donald Trump has promised tariffs on oil, potentially from Canada, or broad tariffs. So there's a lot here to pick up. But I think overall right now, it's a bit of a bearish outlook for oil, given China's economy and given Middle East tensions aren't escalating at this moment.
Patrick DeHaan of Gas Buddy, thanks so much for taking the time here with us today. Always a great pleasure to get some insights from you, Pat.
Thanks for having me.
Certainly. Coming up, everyone, we continue the earnings coverage and push ahead to United Airlines. That's out after the bell. Next on Morning Brief.
Welcome back to Morning Brief, brought to you by Invesco. United Airlines set to report third quarter earnings results after the bell today. It's the second airline to report so far this earnings season. Delta missed expectations last week. Here to discuss what investors need to be watching for, we want to bring in Tom Fitzgerald, TD Cowen's Vice President of Equity Research. It's great to have you here, Tom. Let's talk about this upcoming report here from United. What is the most important key metric, do you think, to watch in tonight's report, and what's really going to give us a sense of the overall health of the airline industry?
I think the main focus continues to be on unit revenue trends, and whether across the geographic entities, across corporate traffic, and as well as other revenue, whether it's the loyalty program or their advertising platform, Connective Media.
So with that in mind, we spoke to Delta CEO Ed Bastian last week on how low-cost carriers are faring right now. And of course, United, as you were mentioning, really kind of is trying to lean more into that premium while also still being kind of everybody's airline, if you will. But this is what the CEO of Delta had to say, and we'll get your reaction on the other side.
Again, business travel being up as well, it tells you that the consumer, our consumer, is doing well. On the lower end of the price scale, however, you can see the effects, and you can see what's happening to the ultra low cost carriers, even Southwest to some extent, that are caught up where there are, I think, some price challenges.
And so how do you anticipate some of those price challenges could play out even for a United, maybe not on the premium end of the offering, but perhaps as you get into some of the kind of lower fare tiers?
It's a great question. I think United is still very well positioned. If you look at where some of their competitors like Southwest or the ultra low cost carriers, where they're pulling back in markets like Chicago, Denver, in Houston, those are major United hubs. So they've had a lot of success in the last 5-10 years rolling out their basic economy product and segmenting their revenue fare offerings. So we can continue to expect them to take share and really attack as the competitors leave some of these markets.
Tom, the lower fuel prices, how much of that is going to add to support here for this quarter?
It's massive. And this is a unique environment where fuel is going down, but industry capacity has rationalized so much that we're actually seeing prices firm up since the late August or early September. That's very rare for airlines. Usually fares and fuel tend to move in lockstep together. But given the profitability problems that some of the laggards in the industry, we're in this nirvana-like moment for the airlines where fuel's falling and prices rising.
Really interesting. Okay, and so, as this is all playing out and as we're anticipating United, we also got to ask you about another airline in your coverage list that's actually going through a proxy and larger activist campaign, and that's Southwest. As you've seen this special vote and the special meeting, rather, be called into the fray here, how do you anticipate that that's going to play out, and what type of pressure does that continue to put on Southwest to make even more leadership changes to really appease some of what Elliott has already communicated and what now investors also have on their plate to consider?
We think it's going to continue to add a lot of noise into the shares, and it's hard to handicap here which way investors vote. We're not really sure that a management change would add a lot of value here, especially given the good relations that Southwest management has with their employee base, which is not a given in this industry. I think it's a critical earnings call next week for them. We're hoping that they unpack more detail on some of the initiatives that they rolled out at Investor Day, specifically some of the ancillaries, and then some of the timing and the mix on their asset sales, and how much will be sell leaseback, how much will be outright sales. And so we think they have a lot more explaining to do and hopefully provide more meat on the bone to what we can expect in 2026.
Is there a risk at all that Elliott's involvement in what they're pushing for is going to jeopardize any of the progress that Southwest might have been able to see here in the coming months that was laid out from their transformation plan?
For sure. Yeah, there's definitely a risk there.
And what does that look like?
Well, it could, you could see employee morale go down if it's a new management team that's not well received. It could just add a lot of noise in the stock, depending if Elliott eventually just decides to move elsewhere with its capital. They have, that's a big position and, $2 billion-ish versus of the float that they'd have to exit from. That's a big weight on the shares. So it's a big risk.
Just as we've been trying to really get our heads around the impact of what's taking place at Boeing to some of the other airlines that are in your coverage as well, how do you anticipate that kind of trickling through to even the financial performance as route schedules need to be modified, more maintenance is required for some of the aircraft that is in fleet as well, and how that all plays into what they've already communicated to the street.
Yeah, they'll have their work cut out for them in terms of network planning and on the operations. You know, to give you an example, United is scheduled to take about delivery of about one plane per week for the foreseeable future. So every week the Boeing strike rolls on, that's going to push their deliveries back to the right. I think airline investors are okay with it. You know, it's never a problem having too few planes. It's usually a good thing for pricing and for margins. It is, as you mentioned, there's a maintenance hurdle, keeping the older planes in service longer. It can be a good thing as long as if you can keep the planes in good shape, it lowers the profitability hurdle because you have aircraft that are close to fully depreciated, and they've had a lot of success taking old 767s, for example, and flying them to secondary and tertiary markets in Europe that are a lot easier to do with an older aircraft than with a brand new 787.
All right, what a time to be a maintenance worker. Tom Fitzgerald, who's the TD Cowen Vice President of Equity Research. Thanks so much for taking the time, Tom.
Thanks for having me.
Certainly. Everyone, coming up, Stocks in 30. We'll break down 3 of the biggest analyst calls of the day and reveal why Goldman Sachs is getting bearish on one e-commerce giant. Stay tuned to find out who. Well, it's on the screen right now. That's it. Hey, welcome back. You're watching Morning Brief brought to you by Invesco. We're taking a closer look at Yahoo Finance's trending tickers. We've got Etsy, McDonald's, and Boeing this morning. We're doing it all in 30 seconds each or less. Let's go. Etsy, it's cut to sell from neutral at Goldman Sachs. Ahead of e-commerce earnings here, the analyst citing risks to current estimates given gross merchandise sales, margin compression in 2025, and the potential for share losses to persist. Shares are off more than 30% so far in 2024. There you're taking a look at the shares of ETSY. Do they have an alibi? Well, let's hope so. Over at Goldman Sachs, though, one of the huge things that they're tracking going forward from here, and this is the last thing I'll note, is the fact that the summary of key fundamentals debates on Amazon into Q3 are that they ultimately see that as seemingly one of the better options right now.
All right, let's flip it over to McDonald's. Price target getting a boost at Morgan Stanley ahead of earnings. Analysts positive on U.S. same-store sales improvement, but still cautious in the near term on the lack of transparency in the international business. Now, in this note, they actually cited some weakness that we heard last week from Domino's, maybe as a forewarning sign or signal here, and some of that weakness to come within the sector. Going forward, though, they were very positive about the U.S., the fact that it is a tough backdrop right now, and McDonald's has been able to show at least consistent improvement there. Another thing that jumped out to me were their plans going forward for their value meals. Some sales catalysts are still to come, including perhaps a permanent value relaunch in 2025, according to Morgan Stanley.
All right, cool. As long as the toys are still included, hopefully.
Hopefully.
Well, those are on the Happy Meal side, I suppose. Anyway, all right, let's go to the skies here. Ending on Boeing. Boeing's price target slashed to $209. That's from $224 per share at Citi. The analysts citing lower cash flow estimates for 2025 and 2026, given some of the charges Boeing reported here. We've also got some news out today, however, showing the company filed with regulators to raise as much as $25 billion to stave off its cash crunch. Shares right now fractionally higher here, but you know what that year-to-date looks like. No bueno.
Doesn't look good. All right, we'll keep right here on Yahoo Finance. That does it for Morning Brief, but Brad's going to stick around some part of the next hour. And we've got more coming up for you next on Catalyst. We'll see you in a minute. Welcome to Catalyst. I'm Shauna Smith alongside Brad Smith. We're 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
All right, first up, we got to talk about U.S. stocks trading mixed after the S&P 500 clinched its 46th record high this year. But is there more room for the market to run? That's the big question. Investors turning to earnings for some answers.
And we'll bring you full earnings coverage ahead this hour as big banks surprise to the upside. But what will regional banks tell us about the health of financials and the overall economy?
What will they say? Plus, we'll dive into results from healthcare companies as UnitedHealth trims its outlook and Walgreens announces it's closing 14% of its stores. We'll bring you the takeaways from the reports and what it says about the broader sector. All that and much more.
Earnings season is a key catalyst for markets this week. Our next guest has some key topics he's listening for on earnings calls this quarter. One of those themes is economic uncertainty. Here's what we've heard from executives so far this earnings season.
We see the spending patterns as being sort of solid, consistent with the narrative that the consumer is on solid footing and consistent with a strong labor market and the current central case of a kind of no landing scenario economically.
Overall, the U.S. economy remains strong, with inflation slowing and a resilient labor market, boosting income and supporting consumer spending.
We want to bring in Michael Reinking. He's senior market strategist at the New York Stock Exchange. Michael, it's great to have you here on set with us. Let's talk about some of the themes so far this earnings season, focusing first on the economic backdrop right now. We just played the two clips that we heard last week. This morning, we're getting some commentary out from Goldman Sachs and Bank of America, citing some signs of economic resilience. Talk to us then about what this signals then for the market's momentum.
Well, first of all, thanks for having me back on. Yeah, look, I mean, so far we've gotten off to a pretty solid start from an earnings season perspective, right? We're getting pretty solid numbers from the banks, right? The general commentary about the consumer has been pretty positive. We haven't seen any big red flags, in terms of credit quality, right? So, from a broader economic perspective, we have, seen some moderation during Q3, but overall the economic activity has remained pretty positive. So as that kind of relates to earnings, that suggests that we should see kind of a reasonably positive earnings season as well. I think one of the key themes that we're watching for this quarter is that we're expecting to see kind of that growth gap between the mega cap tech stocks and kind of the other 493 start to narrow. And I think we're kind of getting to that moment where this is not necessarily that inflection point for the other 493, but you want to start to hear the commentary get a little bit more positive about what's to come.
What's really interesting is especially what we've heard from some of the companies reporting and how investors are reacting to them with regard to the cost-cutting measures that they're instituting as well. And that's seeming like it's providing some of the relief as well. How much more of that do you anticipate to be a larger theme this earnings season where we see perhaps a positive or upside move after the earnings are reported, but pointing back to some of the cost-cutting measures that are being instituted, either on headcount or even on some of the footprint in Walgreens' case that they operate?
Yeah, so that's something that I've been talking about for multiple quarters now, because you've seen companies, kind of instituting, this cost-cutting and focus on efficiency, right? And the point, that I was sort of making was, as we start to see a moderation in economic activity, right, that's going to help to buffer the numbers, and I think that's kind of where we're at in that process. But I think, kind of going forward, what it also does is really create operating leverage within these companies, right? So as you start to see, the economic backdrop, begin to turn, right, that's going to give them additional earnings power. And that's where I think, that's how the street is getting to this kind of 15% earnings growth, as we move out to next year. So, you're factoring in kind of this soft to no landing kind of narrative, but you're also factoring kind of that operating leverage that businesses are going to have going forward.
And you talk about some of those, pressure points here for companies going forward, or maybe why we are factoring in still some of that solid growth. Where does the cost-cutting measures come in? And I guess in terms of how investors should be thinking about that, clearly it's not the same case. You can't kind of paint a broad picture across industries. So how should investors be looking at some of those plans from tech versus maybe what we're hearing from financials this week?
Yeah, so financials, right, that's been one of the real positives that we've seen, right? The expense ratios have been, kind of pretty low, right? So that's been a positive in helping the numbers ultimately. I don't think you're necessarily looking for a lot of cost cutting from kind of tech, right? From that industry in particular, right? I mean, there's still like a big focus. I mean, I guess it depends where you are kind of within that tech landscape. shape, right? But there's still kind of a big focus, kind of on that AI infrastructure spending and the CapEx spending. I don't think you're really seeing a whole lot of headcount kind of reduction there. I think it's more in the manufacturing side of things, the industrial side of things, where you're seeing kind of the headcount reduction and things of that nature.
What type of scrutiny do you believe we might see come forward from investors when companies are talking about some type of aggressive capital expenditure profile, either in the name of artificial intelligence or in the name of whatever the latest and greatest technology is that they believe is going to power their industry forward, that they have to hop onto now in order to reap the benefits later on down the line?
Right, and that's something, and I think that's really a key in terms of how kind of that AI and the tech trade, kind of really starts to kind of play out over the next couple quarters. We did start to see, last quarter where there was a little bit of pushback by the market, right? As companies were increasing their CapEx budgets, right? So you're starting to see a little bit of pushback if the market does really begin to kind of push back more aggressively on that side of things, right? That can create a little bit more of a bifurcation and lead you to kind of that expansion of breadth within the marketplace, away from tech. But from a tech perspective, right? Those stocks have really just kind of traded sideways over the last quarter, right? And so you're still looking at 20% year-over-year earnings growth rates, for the third consecutive quarter, right? So those companies are trading at a higher multiple, right? But you can also correct via time, right? And just allow those companies to kind of grow into the elevated, with those high growth rates, like grow into the elevated valuations, kind of over time.
Great points. Michael Reinking, who is the New York Stock Exchange Senior Market Strategist. Thanks so much for taking the time here with us.
Thanks for having me.
Absolutely. Well, the earnings to watch this week are the banks, and our next guest has a few regional bank names that he likes heading in to some of these prints. We've got David Chiaverini, who is the Managing Director of Equity Research at Wedbush Securities. David, great to have you back on the program with us. So which banks would you be most focused in on right now, your top picks, if you would?
Yeah, so we're really interested in the liability-sensitive banks here, and those are banks that should benefit from a lower interest rate environment. So we did recently upgrade Comerica Bank, CMA. We like them here. They should benefit from lower rates. Western Alliance, we like Western Alliance as well. They have what's called earnings credit rates, or ECR deposit costs. They should lower at a pretty fast clip with lower interest rates. And they also have a mortgage banking business that should benefit with lower rates. And then another name we like is M&T Bank. So they're neutral to rates, but when we look at their credit quality, their criticized and classified assets, which include some commercial real estate loans, those borrowers should benefit with lower rates. So we're expecting their credit quality to benefit really nicely in a lower rate environment. So we like MTB as well.
David, when it comes to some of the movement that we're seeing this morning, you've got PNC touching the highest intraday level that we've seen since 2022 on the heels of their earnings prints. I'm curious, when it comes to earnings growth overall for the regional banking sector, do you see it catching up to some of its larger cap or larger bank peers?
Yeah, we do expect this re-rating to continue. And while lower interest rates, when you kind of zoom out, is normally not good for financials, but given the impact on credit quality, I think that's giving investors as well as analysts like myself become more constructive on the banks because they've been trading at discounts to historical multiples. They're still at a discount to historical multiples, but they're narrowing that gap. So there's hope for a steepening of the yield curve, so that should help banks as well. And then lower interest rates could also be a catalyst for improved loan growth. So there's a few things to get more excited about the banks looking out over the next 6 to 12 months.
Okay, and so with all the excitement and the things that investors could hang their hat on, there's also some banks that might underperform. Where are those kind of areas of weakness that you'd be tracking up against?
Yeah, so sticking with the theme of rate impacts on banks, the asset-sensitive banks are the ones that should be impacted. So we recently downgraded First Citizens, FCNCA. We recently downgraded First Horizon, FHN. They are asset-sensitive. We expect their net interest income to come under pressure. Some of the fees on For Citizens' side, they have client investment fees from off-balance sheet money market funds. They'll earn less fees from those balances. There's a partial offset for First Horizon in that their fixed income trading business and their mortgage banking business should benefit, but we think the headwinds on NII should be, bigger than the offset on the countercyclical businesses. So it's really the asset-sensitive names that will probably see some headwinds.
David, what do you think the deal-making activity is going to look like for regionals?
I think it's going to improve with this theme of lower rates. One of the big items that's been a headwind to M&A activity are these fair value marks, both on loans as well as securities portfolios. They call it the AOCI marks. Those are going to come down meaningfully in a lower rate environment. So that's one headwind that should go away. Also, a potential change in the administration could pave the way for increased M&A activity, because some of the deals that have occurred over the past couple of years have really been hung up, and the approval time has been extended much longer than a typical approval time. So if we do end up with a change in administration, combined with lower interest rates, we could see an uptick in M&A activity.
Dave, let's talk about two calls that you've had recently. It stuck out to us. One of those being the buy now, pay later space. You've got a firm you recently upgraded, getting a bit more positive about that space. You're far from the only analyst covering these names that have boosted your outlook here for the space. I'm curious just what you've heard and why, or what you see maybe as being the catalyst for these names going forward.
Yeah, in the case of a firm, we upgraded this one, again, because of lower interest rates. That's going to benefit their funding costs. So they refer to their margin that they really manage to is revenue less transaction costs, the RLTC margin. They like to manage that in a 3 to 4% range. But with lower interest rates, they could actually end up above that range, all else being equal. But since they want to manage within the range, they'll actually loosen their underwriting standards. They're willing to take on more credit losses. That way it can boost GMV growth and then end up as a net benefit to the bottom line and revenue. So I think the outlook for a firm in a lower rate environment is better as well.
And so resilient has been the word for the economy, but if we're anticipating outperformance for a firm on a lower rate environment, what does that spell out about the true kind of sense in the consumer right now and where that could continue to drift towards?
Yeah, resiliency really has been the name of the game over the past couple years. I was expecting a recession. Clearly, that's not going to happen. Our base case is a soft landing. And on the consumer front, it really is a tale of two cities. The lower income consumers are the ones that are struggling with higher inflation. But the upper end of the consumers, we're at all-time highs, right, with the stock market hitting nearly 50 new all-time highs so far this year. So there's a lot of wealth that's been built up. And then look at home equity. Home equity is really high right now. So a lot of consumers are very strong with their ability to continue their spending patterns. So that's what I think is holding up the economy. So while we do see some weakness at the lower end, the upper end is more than offsetting it.
All right, David Chiaverini, always great to have you. Thanks so much for your insights here this morning. Wedbush Securities, Managing Director of Equity Research.
Thank you.
Coming up, we will be taking a look at some of today's trending stocks. We'll give you the news behind the moves, starting off with Charles Schwab and Aqua. We've got that for you next.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at Charles Schwab reporting a third quarter earnings beat fueled by higher asset management fees. The company also reporting that it was able to pay down some very costly debt. Taking a look at shares right now, higher on the back of this report by about 6, nearly 7% here. And on that modern wealth solutions part of the business here, they did record some record year-to-date flows into the Schwab Wealth Advisory. That helped manage investing net flows reach $40 billion. That right there, folks, is an increase of 65% versus 23 year-to-date, they mentioned.
Yeah, Brad, we were just talking to David Chiaverini in the last block. He was giving us a better sense of where we stand for regionals right now, more specifically, even some of the bigger banks. And he was saying that the big takeaway so far this earnings season has been that we are on solid economic footing. We've heard that from a number of the bank executives here over the last several days. And I think when you take a look at Schwab's results here today, at least that's a bit encouraging. We know they did have an executive change up, just what exactly that means for the moves going forward in terms of the strategy that we're likely to see from Charles Schwab. But again, daily average trades at 5.7 million. That essentially came in line with expectations, but bank deposits did exceed what the street was looking for. Net interest revenue here also coming in at just a bit above what the street was looking for there. So again, overall, a better picture or improving picture here for Schwab, and we're seeing that reflected in the move to the upside here today. Next up, let's take a look at Oklo, the nuclear startup backed by Sam Altman, getting a boost after Google signed, or was getting a boost, is actually now trading to the downside, off just about 0.1%. The move coming after Google signed a deal with nuclear energy company Kairos Power to build small nuclear reactors to power its AI data centers. Now, this is a move and this is a trade that we have been talking about now for quite some time. Oklo, over the last month, you've got shares up just about 58%, still trading here today just above $10 a share. But I think the opportunity that lies ahead within this investment space is something that's garnering more and more investor attention as they do try to focus on maybe that next leg or that next stage of the AI investment story, and some of these names that are set to benefit as we do see an increased adoption here worldwide.
Yeah, I'm excited to put together a little deep dive on this and why companies are talking about this, but I'll give you kind of the high-level overview as to why this matters so much. It's not just Oklo. Of course, it's the focus around how many more data centers are going to see the multiple in the amount of chips absolutely skyrocket. I mean, we're talking about potentially going from 60,000 chip data centers to potentially 1 million chip data centers, as it's been talked about on earnings calls in the past few quarters here. And as I think about some of those earnings calls and the nuclear reactor conversation, even Oracle, if you think back to what Larry Ellison, the chief technology officer, founder over at Oracle, was talking about, he was really laser focused on making sure that they're signing some of these deals to ensure that the nuclear reaction technology is able to give them a better type of energy powering into some of these data centers, knowing the type of demand that that's going to require as well. So all of that considered, that's just a preview to a potential deep dive coming forward here that has been brainstormed in our morning meeting.
I was going to say, when are you going to have that for us?
We'll know at a later date. Yes.
There you go. You don't want to tie yourself to any sort of deadline. Yeah. All right, let's talk about the global investor sentiment that we're seeing. It's the largest monthly increase in more than 4 years. That's according to the latest fund manager survey out from Bank of America. Yahoo Finance's Josh Schaefer is here to break down the highlights. Josh, you've been spending some time on this morning.
Yeah, so BofA's Global Fund Manager Survey for October coming in and saying sentiment took its largest rise in more than 4 years, going back to June 2020. Remember, that was when we were coming out of the pandemic, and you saw a lot of sentiment indicators take pretty big increases. So that's a pretty eye-popping area for this to be related back to. Kind of the key thing that goes into that is it accounts for investors' allocation to cash, their allocation to equities, and then how they're feeling about the overall economic growth expectations for the coming year. So investors said that they now see more likely scenarios of a no landing scenario where the economy would keep growing, or a soft landing, hard landing where we go into recession. That's coming down. So that's kind of your economic narrative piece of this. Now, it does come with one warning sign here. So cash allocation from investors falling below 4%. That has been a contrarian indicator in the next month in 3 months when talking about global equities, when talking about something like the MSCI, that normally falls. For instance, the last time we saw cash allocations below 4%, it was June of this year. What happened in July and August, right? That was our little bit of a pullback. That was our near-term top. But overall, Michael Hartnett in this survey still saying that we have not reached kind of peak bullishness. That would normally come with a different indicator that B of A has that is not pointing to that yet. So yes, some signs of pure optimism here, but I don't think that's necessarily surprising when we keep talking about record highs in the stock market every day.
Day in and day out.
And we keep talking about resilient economic data. Of course, investors are bullish.
And we keep talking about big tech names that continue to make all-time highs. I mean, the narrative, the setup, it's hard to argue with. I mean, there are obviously always areas of risk and weakness here going forward. But again, the overall setup, and like you're saying, the takeaway from the survey, at least mine from quick glance, is that overall it's very positive, and investors are very optimistic maybe about the next couple of months.
Well, yeah, and it's what it comes back to in the economic backdrop as well here. According to the survey, 76% say that they're accepting and expecting a soft landing, 14% say no landing, and then 8% they're saying hard landing as of right now. So that's some of the trading backdrop into the resilience mindset that many investors are.
And it adds up with what macro equity strategists have been telling us, right? UBS's Jonathan Golub out with a note today saying that he thinks the S&P 500 will end next year at 6,400. That's a boost from 5,800 that he had initially seen, or sorry, his 5,800 was his 2024 target. He went from 6,000 to 6,400 for 2024. But he's writing in that note, just the economic backdrop right now is supportive. You're looking at strong GDP, the Fed is cutting, recession risk seems low. You kind of need, and this is what strategists told me when we talked about the 2-year bull market anniversary and what ends this bull market. Right now, it feels like you need a shock. You need that labor market narrative that was building to boil back up, right? Or you need the shock that no one knows is coming to happen, or something that is not currently seen needs to come into picture here to change the narrative. Because right now you're looking at earnings growth, almost double digits this year, into double digits next year. It's simply just a good backdrop.
Yeah, and I think that's also the narrative that we heard from John Solfis here this morning. He's obviously very positive. We're up against his year-end target, and he was saying that the next couple of weeks are going to be critical, and there's a lot to like within this market, even just taking a look strictly at momentum right now. But one thing that was interesting to me was what he brought up in terms of election. And it seems like overall, yes, this could add a little bit of volatility, but it seems like strategists, even within these fund manager surveys, they're very much looking past ultimately the impact it's going to have. Many of them pointing out the fact that, yes, it's going to add some of that near-term bumpiness, but in terms of that longer-term impact, they're not too worried about the next several weeks.
It seems like the election conversation is basically, we're going to get volatility. How much does it actually bring down the major indexes? And then when we're talking about where we could end the year or where you could end next year, you're just starting from a lower point, right? So if we do get a significant drawdown because there is perhaps more uncertainty around this election than you would normally see, if that is something that plays out and you do see a big drawdown, then your S&P 6,000 call for the end of 2024 maybe comes into a little bit of question because we had a sell-off, right? If we don't actually see that drawdown, then that's why people are starting to come out and pound the table for something like S&P 6,000 by the end of the year, because right now you're sitting above 5,800. It's not that far. It's about 2% to get there. So does the election bring in enough vol that you actually get a real drawdown, maybe a 5 to 10% real drawdown? Then it's harder to get back up to some of these levels. But where things stand right now, there's not a lot in the way.
That doesn't seem like it. All right, Josh, great stuff. Thank you. Coming up next, 3 investable ideas outside of AI. Well, stay tuned. We will tell you what those are and how you should play them next.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
1 hour into the start of the trading day, let's check in on the markets to get a look at the major averages. You are pointing to downside here across the board. Pull back here from the record close. You got the S&P off just a fraction here, just below the flat line. The Dow off just about 174, and the Nasdaq now in negative territory, giving back its earlier gains, off just about 0.3%. A couple of big drivers here today are corporate earnings. Starting out with the banks, we are seeing a bit of a mixed picture here, actually. You've got Goldman Sachs reversing some of its earlier move to the upside. You're now looking at losses of just about 0.7%. We also heard from Bank of America. They're out with their results this morning. Overall, very positive here, just in terms of what they're seeing, that future growth, and that is growth expectations. That's giving investors enough to be excited about. Those shares up just about 1.3%. And then moving on to the healthcare space, a bit of a different picture there for UnitedHealth. If we can put that back up on the screen. We also heard from Johnson & Johnson out this morning. So again, a bit of a mixed picture there when it comes to the healthcare front. Also Walgreens, at least that stock up just about 11%, announcing some closures there for pharmacies, further restructuring plans just in terms of cost-cutting measures, and that is enough to boost some optimism surrounding Walgreens. Now let's flip it over to the bond market and taking a look at yields. You got yields pulling back just a bit as we have seen this move lower in oil. You've got oil just around $70 a barrel. The 10-year yield now off about 5 basis points, still holding above that 4% level. Well, still robust AI enthusiasm continues to push the market to fresh highs, with chipmaker darling Nvidia touching another record high at Monday's close. But our next guest seeing plenty of opportunity outside of AI. So let's talk about it with Brad Newman. He's the director of market strategy at Alger. And Brad, it's great to have you here with us this morning. You've laid out 3 areas of investment opportunity that you see outside of AI. So let's talk about one of those, and first being home builders. Why do you see that as an opportunity now, and more specifically, where should investors be looking?
Yeah, well, first off, so I've been on the program several times over the past couple of years, and Alger continues to like AI enablers and adopters, the infrastructure type plays, and those companies benefiting from adopting AI. So that's probably our largest theme. But you're right, we are seeing opportunity outside of AI. So the housing market is both interesting from a structural, secular standpoint and a cyclical standpoint. So structurally, we're short homes in America, maybe 2 million homes. So there's a supply-demand imbalance. So it's an attractive market from that perspective. And cyclically, mortgage rates are kind of elevated relative to the general interest rate picture. So normally there's a spread of 150 to 200 basis points on mortgage rates relative to the 10-year Treasury yield. Today that spread is much wider, maybe 75, 100 basis points too wide, so to speak, relative to history. And so as that normalizes, that's an opportunity. So both structural and cyclical. And there's several stocks around housing that we like.
And is now the time to get into, we had some of those names that you like up on the screen there just a moment ago, but is now the time to buy in, you think, to this next cycle?
Yeah, I think so, because these stocks haven't done so well recently, actually, since the Fed cut. Rates have been up, and that's been hurting the stocks. The market is still kind of in recovery period, so a stock like Builders FirstSource we view as a high-quality way to gain access to the housing market. They provide building materials to builders and contractors, but what's really interesting is they provide a lot of value-added type products. So these are like pre-made trusses, windows, millwork, that kind of stuff, and they earn much higher margins on that, and so we view that as a way to increase margins further over time, and they're great capital allocators, so that's an attractive one for us.
Brad, the second area that you're seeing that we want to highlight is some opportunity within biotech. What does that look like? And I guess more specifically, what makes you a little bit more bullish on this area?
So that one too, I think there's a structural case and a cyclical case within bioprocessing. So structurally, there's more biologics being approved each year. The pipeline is growing, so it's a growth industry. That said, there was an inventory overhang after COVID, and the volumes have waned over the past couple of years, but we think they're on the upswing. And next year is setting up to be a normal year, or perhaps even better than that. So you have this structurally attractive market that's in the midst of a cyclical recovery, and that's positive. So we like some of the life science tools companies that sell into this bioprocessing market. So those are companies like Danaher or Repligen.
In terms of the policies that could come out from either administration going off of the election, how much of that do you think is going to influence some of the moves that we could see specifically within biotech?
Well, no question that a democratically controlled White House and Congress would be beneficial for things like NIH funding, which would be good for life science tools. But it's a secular growth area, and one of the things that we've learned at Alger, we've been in business for 60 years, celebrating our 60th anniversary this year, is that it doesn't make sense to, we think, position portfolios based on policy. If you look after Trump was elected, you would have thought energy would have done great because of the deregulation angle and his views on drilling. But actually, energy was the worst performing sector in the 2 years after that election. And similar, after Biden was elected, you would have thought environmental policies would have boosted stocks like solar stocks, and they were really underperformers over the next 2 years. So we really base our portfolio decisions more around who's winning and losing from change.
And you're also seeing some opportunity within the alternative asset manager space. I'm curious, what do you like there?
So, institutions have long been fans of private markets. They have allocations of, an order of 25 to 30% type allocations, but individuals haven't really been able to play in this market. So we're talking about private equity, private credit, et cetera. There's only about a 3% allocation for the mass affluent. But recently, companies are innovating. That means they're lowering the minimums required to get into this market. They're increasing liquidity, and that's opening up the market to retail investors. And so it's a big growth area if retail investors can adopt some of these private market assets. And so companies like Hamilton Lane, Stepstone, Blue Owl, these are companies that are doing these innovations and opening up the market to the retail investor.
All right, Brad, we skipped over AI. I know you mentioned that you're seeing some opportunity within AI, but rather than talk about specific investment opportunity within the space, I want to pull up a video actually that our producer Kathleen spotted on your site, and she was talking about some of the use that you guys are doing at Alger using your own AI avatar. And I've got to actually admit, we had a tough time, and I still don't know, I'm positive, which one is real and which one is the fake video. But how should investors, how should employees out there be thinking about the evolution and the adoption of AI, and more specifically, what it could mean for a job like yours?
So right now we have this avatar of myself, and we've used it to really enhance productivity and efficiency. So for instance, when there's breaking news, instead of getting my makeup done and having perfect lighting, et cetera, we can kind of type up a script and have the avatar deliver that script to our clients to let them know our views. But it's much more efficient and more productive for us to do so. So much faster time to market. We can get it out within just a few hours instead of a few days, and it's it's more cost effective as well. Now, I think right now it's not really replacing any jobs. I kind of still have to write the script, but in the future, it's possible that these AI avatars will kind of be listening to these interviews, that I give, and maybe I won't have to write the script, and it can just kind of produce views from what I've said, in the past. So
Does that make you a bit nervous? No?
Well, I think not in the short term. I think it could just kind of amplify people's voices. So, and people are already using this in politics and other areas just to be able to project your message in more places. But, longer term, I think people will have to learn new skills. And
Which one is the AI avatar?
I think I was the one on the left in the video
on the left. All right, you know what? That is actually what I guess. So I'm happy. At least maybe I could tell after being told that one was an AI avatar. All right, Brad, great stuff. Thanks so much for joining us here on set. Brad Newman,
thanks for having me.
Director of Market Strategy at Alger. Well, taking a look at shares of Apple hitting its first record high since July this morning. The stock has risen 37% over the past 6 months, more than twice the 15.5% gain of the NASDAQ 100 index. Some analyst commentary out today from Morgan Stanley saying that as of October 11th, iPhone 16 lead times are 3 to 10 days lower year over year, though Pro and Pro Max lead times have extended by 2 days, which the analyst says is showing some signs of stabilization, and the firm calling it, quote, encouraging and in line with recent cycles. The firm keeping an overweight rating and $273 price target on Apple shares. Evercore ISI also issuing a tactical outperform trading call on the stock ahead of its quarterly results, which are expected later this month. Again, you're looking at an intraday gain here for Apple of just about 2% today. Coming up, we've got your healthcare checklist for earnings. That's coming up next on Catalysts. A string of heavyweight healthcare names reporting earnings before the market opened. J&J benefited from strength in its pharmaceutical business during the quarter, while robust procedure volumes dinged a key medical loss ratio for UnitedHealth. We want to bring in Jared Holtz. He's Mizuho's healthcare equity strategist, joining me now for more on earnings. And Jared, it's great to have you here. I actually want to start with your earnings checklist that you have for healthcare, because it's fitting into some of the headlines that we're getting out from J&J and from UnitedHealth here this morning. The first thing on that checklist is healthcare utilization. Talk to me about that, what you learned this morning, maybe about what that trend will then tell us about future investment opportunities.
Yeah, thanks so much for having me. I think as we look at the broader sector, utilization, big picture is still probably the driving factor for just so many of the companies that are going to be reporting earnings, including what we've seen already today with United, J&J, and some others. And, just based on the trends that have been reported, the procedure volume backdrop, at least in the United States, is still very strong, just indicating a lot more patient mobility, more surgeries, more doctor visits, et cetera. This is all leading to much higher procedure volume growth than is normally the case, which, bodes well for medical devices, some other pockets within healthcare, obviously conversely for managed care as they kind of deal with a higher procedure volume backdrop and just don't have enough in the way of cost cutting or cost savings to offset it, at least over the near term. So when we kind of look at, the sector in its entirety, it's really based so much on, what patients are doing, what sort of procedures they're having, and we're finding that they're running still very strong.
So, Jared, when you're taking a look at the drop here, UnitedHealth shares off just about 9% at the open, the biggest drop that we've seen since June of 2023. Is that then a bit overdone?
I think so. I mean, there are a couple ways to look at it. A very crowded trade into the quarter. I think a lot of, members of the buy side, thought this was going to be a stock that outperformed this quarter. Expectations weren't that high. You've got the election just around the corner. So a very crowded long heading into numbers, and they missed their MLR, the medical loss ratio, by about 80 basis points, which is a lot higher than anyone expected. On the flip side of it, it does seem like some of these issues they're facing are more temporary than not, and they can kind of right the ship over the next year or so. And if that's true, the stock right around 550, when I last looked at it, I think it's done a little bit better as of late, is probably a decent opportunity, especially if you believe that, or if investors believe, Republicans are going to be victorious coming up here in early November. That typically bodes well for the managed care group.
So, Jared, the second thing on that checklist, and you just mentioned briefly elections. Let's talk a little bit about that. The implications, what do you see as the implications for the healthcare sector more broadly, depending on who is elected to the White House?
Well, I think healthcare probably performs okay, irrespective of the outcome. I think this is more of a short-term dynamic than anything else. And, investors are kind of rallying around the idea that Medicare rates are usually a bit better under Republican leadership than Democratic. And if that winds up being the case here just in a couple weeks, the Uniteds are going to bounce back, Humana, CVS, Elevance. Companies that have Medicare exposure are likely going to do fairly well. That's a near-term trade. I'm not really sure anything changes for over a year period, a 2-year period. The group probably trades fine as long as there's gridlock in Washington. That's what everyone in healthcare kind of likes. But for a trade, that would bode, a Republican victory would bode well for managed care, less so for providers, maybe a little bit less so for medical devices. But that's like the kind of the first area we're looking at. And then secondarily, pharma, a lot of, steps have been taken to curtail drug pricing with this Inflation Reduction Act. So I'm not really sure there's that much volatility there. But I think the other thing we have to kind of keep in mind is that Republican leadership, I think when investors look at it, the premise is that they're more helpful than not for larger scale M&A. And I think pharma and biotech would trade probably better on that than they would if Democrats were to win.
So where does all this leave M&A activity more broadly? A lot of that obviously dependent on the overall market environment. Right now we're seeing rates tick a bit lower. What are your expectations there? And does the pharma industry still need to be aggressive on this front?
Yeah, they certainly do. I mean, the next 5 years are incredible just in terms of big drugs that are going off patent. And all of the pharma companies are kind of subject to the same macro challenges across the board, which is to say that, these assets in the pharmaceutical industry are not durable, and they have to continuously, do M&A in order to kind of, keep revenue growth going and keep earnings growth going. So I think we're set up really well for a big year in M&A. I think a lot of investors would agree with that. 2024 so far has been a little bit quiet relative to historical years. That's probably driven by a couple things. One, last year was very strong, so we're coming off of pretty tough comps, and pharma companies have to integrate what they've done. And then secondly, I think the election might have a little bit of a role here, just as companies try to get a little bit more clarity on who's going to be running the show. But I think as we look into 2025, probably a pretty decent year for M&A. That would include biotech, that would include medical devices, and maybe even services. I know there are some investors who think that Cigna and Humana will wind up happening as a larger Medicare or managed care deal, rather. So maybe that's in the works over the longer term.
All right, Jared Holz, always great to get your insight. Thanks so much for joining us. Mizuho's healthcare equity strategist.
Thank you.
Coming up, we've got much more of your market action ahead. Stay tuned. You're watching Catalysts. Trump Media and Technology Group, a ticker DJT, shares extending their rally today. The stock making moves as investors continue to see the former president's social media platform as a proxy for whether or not he will win a second term in November. You're looking at gains of just shy of 7%. Also watching the former president's World Liberty Financial, a cryptocurrency platform, launching a new token today. The pre-sale of the token set to start today, but only to those who are pre-qualified. Those people are eligible to buy. The project reportedly aiming to raise $300 million from the initial sale and will sell 20% of the token supply at a $1.5 billion fully diluted valuation. Sticking with crypto, Bitcoin paring some of its earlier gains after topping $67,000 for the first time since July. The move's coming after Vice President Kamala Harris announcing plans to come up with rules to protect crypto and other digital assets. Former President Donald Trump previously echoing a pro-crypto tone, saying that he wants the U.S. to become the crypto capital of the world. To discuss potential policy implications, we want to bring in Lee Reiners. He's from the Duke of Financial Economics Center. And Lee, it's great to have you here. Thanks so much for taking the time. We were talking to Anthony Pompliano on the show yesterday, and I asked him this question about whether or not one candidate is better than the other just in terms of the future of crypto. And he said it's very much still a show me story and there's uncertainty on both sides. I'm curious, what do you think?
Well, look, I mean, I think if your primary concern is the price of various cryptocurrencies, I think it's pretty clear at this point that a Trump administration would have sort of a more positive impact. I've always maintained that for crypto to be successful over the long term, you're going to have a lot more people trust it. And, when most people think about crypto, they probably think of Sam Bankman-Fried and FTX and numerous other crypto failures. So there's still a lot of people who are sitting on the sidelines, not really trusting this asset class. And I think one way you engender trust is to have meaningful regulations in place that provide the basic consumer protections that consumers and investors have when it comes to securities and banking and other traditional financial assets. So I think long-term, actually, a sensible regulatory framework would be better for crypto, but I don't think that's what the Trump administration has in mind.
So then, speaking with what the Harris administration has in mind, still light on the details, but it does sound like she's coming around or being a bit more pro-crypto in her most recent statements. Are you then more encouraged, I guess, by the fact that maybe she will be able to implement something that would then win back the trust or win back some of that lost trust there from investors?
Yeah, I mean, as you mentioned, it's still very light on details. I mean, she did give, she released a plan yesterday, her opportunity agenda for Black men, and the plan noted that over 20% of Black Americans currently own or in the past have owned cryptocurrency, and therefore she wants to provide a regulatory framework so that Black men and all other Americans who participate in this market are protected. So that's kind of that's the most detail that the Harris administration, or the Harris campaign, has provided, which of course is not a lot. So what that means, it's hard to tell. I mean, I think, though, that she is, and her team is acknowledging that the current status quo is sort of untenable. And we have this big gap in crypto spot market regulation, right? The big debate in crypto over the past, frankly, decade is, are these things commodities or are they securities? Now, the industry is very vigorously resisting attempts to regulate crypto as a security. They don't want to be regulated by the Securities and Exchange Commission. They'd rather be regulated by the Commodity Futures Trading Commission, or the CFTC, but the CFTC only regulates commodity derivatives markets. They don't regulate commodity spot markets. So when you look at crypto exchanges that are operating in the US, the largest, like Coinbase, Gemini, Kraken, they claim that all their listing on their platform are commodities. So they're not subject to any type of meaningful federal regulation at this point. And even they recognize that has to change. So the debate is which agency should be given oversight over these spot markets. And the Harris team and campaign still hasn't weighed in on that critical question. So there's a lot we're still waiting for here.
Let's talk about Wall Street's most recent commentary when it comes to crypto, and what Larry Fink, as CEO of BlackRock, had said earlier this week really stuck out to us. And he basically said that he emphasized Bitcoin's growing legitimacy as an investment, calling it an alternative to commodities like gold. My question for you is, when you get commentary like that, what do you think this signals for traditional investors, and going back to that, winning back that lost confidence maybe amongst those that when they see commentary like this, they're more likely then to invest?
Yeah, I mean, I think that's true. I think when you have someone of Larry Fink's stature, saying positive things about crypto, that's going to bring in a lot more people off the sidelines, particularly institutional investors. And of course, BlackRock is a leader in institutional investing and in ETFs. Their ETF for Bitcoin is the most popular Bitcoin ETF. And I think that has brought in, a lot more money into this asset class. When he says these things, though, I don't really put a ton of stock into them, frankly, because he's changed the tune over the years on crypto. And I think, from BlackRock's standpoint, they're in the business of providing what their clients want. And they've heard from many clients that they want sort of a regulated, trusted digital asset product. Mm-hmm. And that's what, and that's what they're providing. So they don't really have any skin in the game, so to speak. It's not as if Bitcoin or digital assets are on BlackRock's balance sheet, right? They're just catering to investor demand. So, I think it's positive, certainly for the crypto industry, but, big picture, I'm still a bit skeptical that he's sincere about this.
All right, Lee, great to get your insight there. Lee Reiners of Duke, thanks so much for taking the time.
Thank you.
Keep it right here. Wealth with Bradley Smith. He's got you for the next hour. I'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. On today's show, we'll dive into your portfolio and how to account for the third quarter earnings season in your investment decisions. And it's the first day of Medicare open enrollment for 2025. We'll break down everything that retirees need to know to make the right choice for your medical coverage. Plus, today is the tax extension deadline. If you were granted an extension to file for the 2024 season, today is the day to pay up. If you can't pay, we're going to be bringing on an expert who can talk through some of those options for you. All that and much more during today's show. But first, let's take a look at some of the market action. 90 minutes into the trading day, we're taking a look at a down picture right now. Just a little bit of a breather here after we had seen some new record highs on Monday to begin the trading activity. But with results from big banks in this morning, the earnings season could be a catalyst to push stocks even higher as the bull market turns 2 years old. For more on how to play into earnings season and position your portfolio for year end, we've got David Miller, who's the Catalyst Fund Senior Portfolio Manager, here with us. And so, David, first and foremost, as you think about this earnings season and the potential that that could do for momentum and be for momentum for this market, what most notably would need to happen in order for some of the gains that we've seen and new all-time highs that we've also recorded to continue to be notched in all anew, if you will?
Yeah, so one thing that we look at when we're evaluating earnings in the Catalyst Insider Buying Fund I manage, INSIX, is that we look for companies where they've demonstrated clear post-earnings announcement drift. So post-earnings announcement drift, or PEAD, is one of these phenomena that's one of the most powerful anomalies in finance. And basically what it says is that companies that have historically beat earnings in a significant way consistently tend to continue to beat earnings and their stocks continue to do well. Same goes for those that have missed earnings consistently, they continue to do poorly. So not a surprising concept that winners tend to continue winning and the losers tend to continue losing. So what we're really looking for is those stocks that have had a history of beating their earnings announcements. And there's a number of sectors where we've seen that more recently. You can see it in healthcare with like GLP-1s.
Sure. And I was actually going to ask you that. Which sectors typically stand out with the post-earnings announcement drift?
Yeah, absolutely. So, healthcare, like Novo, we've certainly seen it on MVO. We've certainly seen that in terms of the networking space, companies like Arista Networks. We've also seen that in companies in the payment technology area or Visa, MasterCard, firms of that nature. So those types of companies have been good examples of it.
And so with that in mind, as you're kind of looking through the potential common denominator that a lot of companies are going to be discussing over the course of this earnings season, what should investors be prepared to hear from companies and their CEOs and executives that are going to be breaking down every line item or the nitty-gritty of how it's all playing into their previous quarter's performance, but also how it factors into their outlook too?
Sure. So I'd really break it down into two categories. There's some companies where it's pretty hard to predict what their earnings are going to be, and it's more driven by the macro picture. I'd frankly avoid those. And then when you look at the companies where it's more easy to predict that they're going to continue beating, it's those where they have some significant, unique competitive advantage that gives them an edge. So like if you look at Kinsale Capital, for example, like KNSL, they've had 4 quarters of consistent, significant beats. They've grown earnings and revenue both over 30% annualized. And it's because when they approach insurance, they're in a specific place that's called ENS, excess and surplus. So they're not like insuring against hurricanes or earthquakes, things that are hard to predict. They're going for smaller businesses that have really unique things that need to be insured that most big insurers want to stay away from with a simple model, so they can be in a non-competitive niche. So they're certainly a good example.
You know, with that in mind, where are the sectors that you would be a little bit more wary of over the course of this earnings season?
Sure. So I guess another good example would be those where they can have a history of missing and not putting up good returns on capital. So airlines would be a great example of that. They have a high fare cost to deal with, GDP growth that's been a little bit slower. pretty close to perfect competition. So they've generally been kind of crummy businesses, and they're probably likely to continue to be as such.
That's interesting. And so as we're thinking about the macro backdrop, which you really were breaking down well there, it all comes with this broader kind of mindset of how much are companies also going to need to spend in order to initiate that next leg of growth? And how should investors be evaluating some of those capital expenditures that companies are announcing?
Well, frankly, what you really want is those companies that don't need to put up a lot of CapEx to grow, where they can benefit from other companies putting up the CapEx. So if you look at a space like data networking, clearly there's been tremendous spend, well over $1 trillion into the development of AI. So if you look at a company like an Arista Networks, for example, they're really piggybacking off of that, getting 30% plus growth as well with high margins. With key networking technology that you need to benefit from that AI revolution. And all the hyperscalers need to pay both an Nvidia, but also companies like Arista to be able to take advantage of that. So I think it's really trying to focus on where you can get the benefit without putting up the CapEx.
Is Nvidia still the bellwether of this earnings season too?
No question. I mean, Nvidia has gotten to be so big, and I mean, they've consistently beat, quote unquote, although some of the beats, like the last beat, were really more of a miss because the whisper numbers were a good bit higher. But they're certainly the bellwether, especially for anything chip related.
David Miller, Catalyst Funds Senior Portfolio Manager. Great to have you here with us today.
Great to be here. Thanks.
Absolutely. Medicare open enrollment for 2025 begins today, October 15th, and runs through December 7th. During this time, people who are already enrolled can make changes to their coverage, which will go into effect on January 1st. But it's a big deal this year because there are some significant changes kicking in for the new year. Yahoo Finance senior columnist Carrie Hannon has the details.
This is a significant year for changes to Medicare plans, both traditional Medicare and Medicare Advantage. So it impacts about, over 65 million people are participate and are beneficiaries of these plans. And so this year, we have three big changes to focus on that I think it's critical that people pay attention. You started in September, you got a notice from your plan provider saying, what the changes were coming in 2025. So these are changes that are going to start in January. But most people, 7 out of 10 people just say, skip it. I'm happy. I'm leaving it. I don't want to rock the boat. But this year, don't do that because three new things are coming on. First of all, there's going to be a cap on how much you pay out of pocket for your Part D drug plans. So this is part of traditional Medicare, but that $2,000 cap is really a big deal. And what that means is that Medicare providers, the Part D drug providers are shifting the plans a little bit. So you want to look carefully if your medications are listed. Have they moved to a different tier so they're more expensive? It's important to really closely look at whether your plan covers the drugs that you're on this year because this is a business. People are shifting things around. But again, the second thing is a good thing as well is you have to sign up for this, but if you have these Part D drug plans, you can have a plan. Instead of paying for all your pharmaceutical drugs right up front at the pharmacy counter, you can be billed monthly for this. This is super helpful for people with their budgeting, their cash flow, but you do have to go and sign up for these things. Medicare Advantage plans will also see some changes this year because as more people have shifted into these Medicare Advantage plans, it's now the dominant form of Medicare coverage. Is these plans has gotten kind of expensive because people came to them because you've got vision is included, dental is included, gym memberships, all kinds of fun stuff. But it's a business here. So as more people go in, it's more expensive to operate these plans. So look carefully. Is your Medicare Advantage planning, your gym membership may no longer be there. Your vision benefit may shift a bit. And again, a lot of Medicare Advantage plans are stepping out of markets this year going into 2025. And health systems are dropping Medicare Advantage plans. So make sure that that you still have access to your doctor through your plans. Now, how are we going to find all this stuff? I mean, it is super complicated. I'm not trying to make it sound simple, Brad, but there are places you can go to get some help because this year you may very likely see bump ups in premiums. As I said, your drugs may shift around, what's covered, what's not covered. three places that I recommend people go to. Number one, go to Medicare.gov. They have a plan finder. You can compare plans in your area by your zip code, what changes might be afoot and how you can find some help there. The state health insurance assistance program, I absolutely love. They're super helpful. And the website is shiphelp.org. Check that out if you need help there. And also, there's the Medicare Rights Center, and it's an 800 number. You can reach out. There are people there to help you navigate that. You can save yourself a lot of money if you just take the time to do some shopping. This year, it's more imperative than ever.
Our thanks to Yahoo Finance's own Carrie Hannon. Coming up, everyone, we continue our coverage of Medicare open enrollment. We'll bring you retirees, everything that you need to know to make the best decision about your coverage. Stay tuned. Medicare open enrollment is a little different this year. Thanks to the Inflation Reduction Act, recipients will now have a $2,000 cap on out-of-pocket prescriptions and more. But our next guest thinks that the changes might not be all that positive. For more, we have Melinda Coghill, who is the 65 Incorporated co-founder and partner here. Melinda, great to have you here with us today. So what are the three things that people need to know about the changes this year?
Sure. The first and foremost thing about Medicare open enrollment is that the new $2,000 out-of-pocket spending limit, yes, as you said, Brad, may not be all that. The reason why is this spending limit only applies when your medications are covered by your Part D prescription drug plan. That's a huge caveat to know about. Again, if they are only going to hit the cap if the medications are covered by your plan. If they are not covered by your Part D prescription drug coverage, either through a Medicare Advantage plan or a Part D standalone plan, you're going to pay the full retail price, whether that price is $500 per month or $30,000 a month. That's on you. And just because your plan covered the medication this year does not necessarily mean that it's going to be covered next year. Part D drug plans, again, whether through a Medicare Advantage plan or in a standalone Part D prescription drug plan, the formularies can change from year to year. It is super critical you take a look at the annual notice of changes that you've received at the end of September, beginning of October, and actually take a look. Are the medications that you take still covered in the plan next year? Because if they're not, no $2,000 out-of-pocket spending limit will apply. You need to really take a look at that. And the second thing, as Carrie Hannon said before, is the fact that the networks are getting a lot tighter on Medicare Advantage plans. You need to look. If you have a Medicare Advantage plan, you need to check not only the Part D prescription drug coverage, but you need to check the provider networks. Providers, you may have an out-of-network benefit to your Medicare Advantage plan, but that does not mean that you can see any provider you want. Providers out of network have no legal obligation to take out-of-network coverage. And as a result, we are seeing this across the country. Scripps in Southern California, Baptist in Kentucky, now Essentia and Health Partners in Minnesota. These organizations are saying, no, we're not going to take these Medicare Advantage plans in network or out of network. Take that coverage someplace else. You need to take a look. The other thing that's going on is you absolutely do need to know about the smoothing plans.
Yeah.
They are still brand new, so they're a little rough right now. The government doesn't quite know what's going on with the smoothing plans. That's the budgeting of the drug coverage.
How many people are anticipated to be impacted by these changes? Is it clear? Do we have a sense of that?
Oh, everybody enrolled in a Medicare Advantage plan or a Part D prescription drug plan. So honestly, probably about 70% of the people 65 and older and enrolled in Medicare right now. That's a lot of people, and they all need to be taking a look. But on a good year, on a normal year where we don't have a $2,000 out-of-pocket spending limit, talking point, only 3 out of 10 people would review their coverage. But with this massive $2,000 out-of-pocket spending limit talking point, I'm imagining that fewer people than a normal year will actually be reviewing their coverage. They're leaning on the fact that the most they will pay is $2,000. But the most you will pay if your drugs are not covered by the plan is the full retail price. No spending limit will apply.
Interesting. Melinda, while we have you here, we want to give folks some actionable tips as well for retirees that are shopping healthcare options and trying to figure out what's the best coverage for them. How can they really go about identifying the best way forward that's going to give them the most adequate coverage that they need?
So as Carrie said before, too, there are actually a few places you can go to Medicare.gov. The downside to Medicare.gov is you need to be able to understand how to compare plans. It's not all about the monthly premium. You need to look at your total out-of-pocket cost if you're going to use Medicare.gov to review plans. You can head to your local pharmacy that you get your prescriptions refilled at. But the downside to that is they are only going to compare the costs using their pharmacy refill service. I've saved clients hundreds of dollars, thousands of dollars, not by changing plans, but by changing pharmacies. So you need to take a look at different pharmacies. The last thing, well, not the last thing, but you can also go to state health insurance programs, also known as SHIPs. These are staffed typically by volunteers. So please know that I've been doing this for almost 2 decades now, and I'm still learning things. They typically have about 4 weeks of training. Be nice to your volunteer, but you're going to get who you get. There are also fee-for-service advisors like us. We don't sell Medicare insurance. We make no money from the sale of insurance, so we have to charge our clients for the services that we use, but we're an option as well. So choose your poison. What's best for you?
Melinda Coghill, who is the 65 Incorporated co-founder and partner. Melinda, thanks so much for taking the time and some actionable tips
Brett.
as well. Certainly.
Thanks.
Sticking with Medicare open enrollment, one key detail you should be watching in your Medicare open enrollment is how next year's cost of living adjustment, or COLA, stacks up against your Medicare premiums. Because if your medical premium increase is greater than COLA, that will trigger the hold harmless provision. The Medicare hold harmless provision prevents a recipient's Social Security benefits from declining year over year as a result of an increase in deductions for the Medicare Part B premium, according to Investopedia. So this means your Medicare Part B premium, which is the monthly payment for your Medicare's medical insurance, cannot rise more than Social Security's cost of living adjustment per year, also known as COLA. So your Medicare insurance premium will never rise more than your COLA adjustment. And remember, your premium is determined by your income. So how do you know if you qualify? Well, to qualify for the provision, recipients must have Part B premiums deducted from Social Security benefits received in December of the prior year and January of the current year. But the provision isn't for everyone. It does not apply to those who make payments for Part B insurance directly to Medicare and those who have premiums that are paid by Medicaid. So what do you do if your premium actually goes up more than your cost of living adjustment? Well, that's pretty easy. Just request an appeal with your local Social Security office. But remember, your Part B costs can change every year, so you'll almost always see a change in those bills. You can check the amount and follow up with Medicare or the IRS if you have any questions or concerns. It is the last day to file taxes if you've received an extension. What you need to know to avoid penalties, that's next on Wealth. You're watching Yahoo Finance. If you still need to file your 2024 taxes, today is the day. It's the deadline for filers who were granted an extension in April. Here with more, we've got KKOS Lawyers founding partner, Mark Kohler. Mark, great to have you here in studio with us.
Thanks for having me.
I mean, I guess a happy deadline day to all who are trying to get their paperwork in. What do people need to know, though, if they still haven't filed?
Well, this is a huge day because 20 million Americans filed an extension and bought time. But then in today's economy, so many people are struggling financially and maybe can't pay. And so they think, well, if I don't file, I don't want to let the IRS know I owe. That's the worst thing you can do. The penalty is 10 times more for not filing than not paying. And a lot of people don't realize that. So it's better to just let the IRS know I owe you, but I can't pay. And then we work through options to deal with that.
Sure.
But today's a big deadline.
Let's work through those options as well here. And you were breaking down some of the penalties. We have those on screen for our viewers at home. But when you think about the options and making sure that you're working through all of the potential way forward for a lot of filers out there, what is the typical that you see most often, the mode, if you will?
You bet. There's so many different paths to take depending on your financial situation. But the most common is get filed. Even if today you're just not sure how much you owe, take your best estimate and file. Because again, that penalty for not filing is the worst. The IRS just wants you to know, when you go on that first date, you promise you're going to call them back. If you don't call, that's when you get your car keyed. The IRS is not happy if you just leave them in the dark. They want to know what's going on.
Yeah.
You got a relationship there. And so anyway, but you want to get that tax return off, and then you can call the IRS and do a 30 to 60 day hold on collection. Say, hey, let me make a game plan.
Sure.
So I can call the IRS. Now, by the way, the major scam out there, the IRS will never call you or never email you. So people, if you ever get that call, just know it's a scam. But call the IRS, ask for 30 to 60 days, and then you can start talking about maybe an installment agreement and other avenues. And the installment agreement is not the end of the world. Get your tax returns filed, get on a payment plan, and then get back to living your dream and being more proactive so it doesn't happen again.
What are some of the biggest tax changes that you see filers anticipating for 2025 as well?
Well, we're in an election year where everything's up for grabs. So what I tell people is worry about your own economy. Don't worry about the bigger picture of who's making what promise for tax benefits. Just what is your plan? Are you out of debt? What are you doing as that side hustle to make a little extra money? Side hustle shouldn't be a burden. A side hustle is an opportunity for the American dream. 50 million Americans now have that little side gig, and it's so powerful.
And so with that in mind, and the amount of Americans that do have that side hustle, how much more complicated does that make the tax filing process for households?
Well, I don't know if I use the word complicated, but gives you more opportunities, because now we're getting more write-offs, which brings us to moving forward. For those that haven't filed, get in and file. But now we're turning in the corner into the most important time of the year, and that's year-end tax planning. Real accountants, this is when we're busy. So if you have that side hustle, we want to take advantage of a number of tax strategies before year-end, because come January, game over. That's the buzzer's December 31st. So let's get in some strategies before then.
You mentioned it's not the complications that it brings up in having a side hustle, but it's the opportunity because of the write-offs. What do you think is the most missed opportunity with regards to write-offs?
Oh my gosh, a side hustle, for so many people, they miss the boat that it's really a family business. It's an opportunity to bring the family together. Even if you're just driving Uber, maybe it's an online business, maybe you're selling a product, a service, you're trying to make ends meet. Turn it into a family affair where now the whole family knows what's going on. You're communicating about financial literacy, and the number one strategy is having that family board meeting, getting your family on the payroll. Instead of paying taxes and giving your kids money or supporting other family expenses that could actually be related to the business, we're now creating tax write-offs, tax-free income, the ability to build real wealth. It's so much opportunity missed there.
How can you put your company and your family on the company payroll without setting off any alarms by the IRS and passing the IRS sniff test?
Oh my gosh, it's not high risk. Think about the New York City deli, where they've got their kids working in the deli after school. The Oklahoma farm, where the kids are working on the farm. Back in Idaho, the kids are working on the potato farm. Or you're a realtor in LA and you've got your kids helping put signs in the yards of your open houses. Whatever you can to have your kids help out, you can pay kids under age 18, now up to 14,000 plus, and they don't even pay taxes. The the kids don't pay taxes on their earned income. You don't have to withhold FICA. You don't have to issue a W-2. It's very, very common. It's not a high-risk issue. But families, they pay these higher tax rates, and then they give their kids money. Let's get them in the business. Let's teach this American dream to our next generation.
Mark Kohler, KKOS Lawyers, founding partner here. Mark, thanks so much for joining us.
Thanks for having me.
Absolutely. Everyone, coming up, shopping tips galore. We'll bring the latest big deals and those days that you're expecting here, and the holiday shopping trends that we're expecting to see on the other side of this short break, plus the best time to buy a car. That's next on Well.
Are you a passionate investing bull? Maybe love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
If you have any money left after Amazon's Prime Day, brace yourself. The world's largest annual shopping festival, 11/11, Double 11, Singles Day, whatever you're calling it. Calling it started as the antithesis to Valentine's Day as a 24-hour shopping bonanza on November 11th. Now the sales have already started a month earlier. Yahoo Finance's Rochelle Akufo explains how to navigate it all. I mean, my goodness, we're just starting all these sales earlier and earlier, Rochelle. PSL is earlier, Amazon Prime Day is earlier, I mean, and now Singles Day. All right, what do we need to know?
Everything. Everything. It starts earlier and now it's on even longer. This event was originally started by Chinese e-commerce giant Alibaba in 2009. Now it spans over 200 countries with an estimated 300,000 global brands participating, including Nike, Dyson, and Sephora. So here are the best ways to shop the event if you're not familiar with it. First, stick to reputable retailers and platforms. Do your homework and shop from trusted online stores or platforms. Read those reviews and only use payment methods that have buyer protection. Next, something that you should already be thinking, avoid too good to be true deals. Now, there are going to be some deep discounts, but be wary of extremely low prices on some of the most popular items. Verify deals by cross-checking the price elsewhere as well if you're not sure. Also, check for secure sites. Ensure that you see that HTTPS encryption in the website address and avoid sharing your sensitive details and card information if you don't see it. Another tip, research the return policies and shipping terms. Yes, we all tend to skip it. It seems quite boring, but you do have to read the store's return policy and shipping details, especially for some of these international purchases that may charge, say, extra shipping fees for returns or only offer store credit. And lastly, use those tracking apps or alert options. Set up shipment tracking alerts using apps like Shop and only sign up for alerts from the official store website. Now that's going to help limit some of these scams or phishing attempts that can be disguised as order notifications.
So how popular are Singles Day sales?
I mean, the numbers are quite staggering. Last year, Coresight Research estimated that Singles Day shopping events brought in over $137 billion in sales in 2023. Now, by comparison, Cyber Week in the US, which includes Thanksgiving, Black Friday, and Cyber Monday sales, that hit about $38 billion. But most US shoppers do still prefer the Cyber Week sales, but they are increasingly checking out Singles Day sales as well. So those are some tips to, if you are interested in perhaps spending a bit of money before it all runs out by the end of the year, just do your homework. But you know, you can find some deals on there as well, Brad.
All right, Rochelle, excellent breakdown. We know where to find you in the interwebs. Thanks so much. You can get much more of Rochelle on Yahoo Finance's Capital Gains podcast. That's every Friday, 12 p.m. Eastern, wherever you get your podcasts. Well, holiday shopping season is here. As early as October, events from Amazon, Target, Walmart, Alibaba, they get consumers in the doors earlier this year. While inflation remains a concern, shoppers are feeling more optimistic and plan to increase their spending by 8% year over year, according to Deloitte's annual holiday survey. Here with more insights into this spending season, we've got Brian McCarthy. He's the principal of retail strategy and transformation at Deloitte. Great to have you here with us. All right, so just take us into the year over year growth first that you're anticipating, even with some of the inflationary and price pressures that consumers have cited as well.
Yeah, Brad, thanks very much for having me. So really we're seeing after this year of frugality and restraint, consumers are feeling a bit more optimistic about the economy. They're planning to have a very festive holiday season. This 8% year over year increase means we're going to be seeing a record high of $1,778 of spending. The reason holiday shoppers are going to spend higher this year is driven primarily through a rosier economic outlook. We're seeing about a 9 percentage point increase in positivity towards the future of the economy. And then the perception of just higher prices is 70% of shoppers still believe their prices for gifts this year will be higher than last year. We also talked to retail executives who also very optimistic about the upcoming season. 80% believe that they're going to see stronger sales both online and in store.
Brian, with all of this in mind, there's an interesting brand loyalty crisis that's been pointed out as well here. Consumers looking for deals and not just going to go back to the same brand if they don't feel like they're getting a valuable purchase or getting value from the dollars that they are spending. Walk us through that brand loyalty crisis and who it might impact the most.
Yeah, absolutely. I mean, to your point, right, at the end of the day, consumers seek quality, they seek value, and they seek a variety when they go holiday shopping. And with the perception of higher prices still top of mind, consumers are really caught between trying to stretch their wallets and being festive. And so this really means they're torn between seeking value and remaining loyal. They've actually indicated to us that they're really looking for deals this year. So 2/3 are going to be willing to switch their brands if they find that prices are too high. And half of shoppers this year are even willing to switch the retailers that they shop most frequently if they feel the prices are too high. Again, when we talk to retail executives, we're also seeing that they believe private label sales are going to grow faster than national brand sales this year. So if you're a retailer, you really want to make sure you're focused on providing that good quality, good value price point, and a variety of selection that's in line with what shoppers are looking for this year.
What are some of the categories that you expect to remain hot or to year over year at least show some improvement, and then categories that might underperform?
Yep. So some of these won't be that surprising, right? Clothing and accessories is the largest spend category we see. Though the largest growth category we're seeing this year is going to be within food and beverage. Part of this we think is because through the pandemic years, people have really loaded up on a lot of the materials, electronics, gifts that they really wanted at home. And so now there's an opportunity to lean more into experiences and give people food and things that enable them to share the holiday season with others. The biggest decrease category we're seeing this year is gift cards. We're seeing about a 12% decrease in gift card spending this year, and we believe, again, the primary reasons for this, partly due to gift cards, a very strong category last year, and people don't always like to give that 2 years in a row. Another is with the inflationary environment, the buying power of that gift card might not be as much as it used to, so that $50 gift card isn't as meaningful of a gift as before we saw as much inflation. And the last is this growth of wish lists. We're seeing about 50% of shoppers this year indicating the use of wish list. And this makes it easier to share with others things that are top of mind for you. So that aunt or uncle who tends to give you that gift card may be now more confident and able to get you something you actually wanted.
Brian, just lastly, while we have you here, one of my favorite kind of viral trends is shoppers who go into a store and they'll pull back like a sale sign, and there will still be the old sticker behind it or the old price behind it. And let's say you're actually not getting a deal. They're just putting some fresh creative, some fresh kind of, fonts on the ultimate price tag there. And so how can people know when they are actually getting a deal and making sure that, if there's a percentage threshold they should be looking for to understand when they're actually kind of going into a store or shopping online and there's been a significant markdown on a price?
So I guess you need to be clever in that instance, right? Like shoppers are encouraged to explore multiple retailers to look for a competitive deal or a price point that they think is going to work for them. I have found AI is a really interesting thing to start asking for where you may find particular products or promotional deals so you can use technology to be a bit more savvy that way. But I really think at the end of the day, it's an individual decision. When you know there's a certain product that you're looking for, what is the value to you that you're looking to pay for that product? And I think that value is not just the price point, but there's also, value for time. Do you have a seamless, smooth experience? Is the checkout process easy? Do you have an enjoyable time if you're shopping in store or a smooth one if you're shopping digitally? I think that all matters towards a meaningful value experience.
Great point. Brian McCarthy, who is the Deloitte Principal of Retail Strategy and Transformation, joining us here today on Yahoo Finance. Brian, thanks so much for the time. Appreciate it.
Yeah, thanks, Brett.
Certainly. Well, from gift shopping to car shopping, many consumers actually purchase cars around the holidays, with December often considered to be the best month to purchase a vehicle, according to Edmunds. So with rates coming down, how do you choose the best car for you or a loved one this holiday season? Here with some tips, we've got Ivan Jury, who is the Director of Insights at Edmunds. Ivan, great to have you here with us. All right, so when do I know I'm really getting a deal that's worth the big red bow that they're going to slap on that vehicle that I got to drive home?
You're going to know when you drive away and you don't question every single part of the deal, right? It's one of those things where it's inevitable, though. It's literally the second thing that comes after signing the paperwork is, did I get a good deal? And thankfully, you can go online, you can find out what other people paid. You can look at what the interest rate was that you got versus everyone else. Like, thankfully, you can check those things now, right? The cloak and dagger, the black magic behind, like, the transaction, a lot of that's like very transparent now. So thankfully that component you check and you look for comps specific to you, right? The vehicle, the location, people's similar credit scores, things like that. But it's one of those things where we are starting to see more deals in kind of like a universal manner because there are too many 2024s on dealers' lots. And, like inventory is improving in that sense. So it's not nearly as sketchy as it was 2 years ago when everything was so tight.
What trends are you seeing in what buyers or potential buyers are valuing when they go to purchase a car right now?
We're actually seeing kind of mixed results in the market right now. If you looked at EVs 2 years ago, they were the hottest selling vehicles out there. Right? People are trying to buy them sight unseen. You got reservations. Now, complete opposite. OEMs are putting a lot of subvention on leased interest rates. They're trying to put a lot of money, cash on the hood for EVs too. So it's something that you can get a deal on those almost universally. That's everything from luxury to mainstream. On the flip side, the more traditional, with the hybrid or the plug-in hybrid, those vehicles in which people have kind of bypassed for a few years in order to go full EV, they're back into kind of consideration to the point where some of them you still have to order ahead. You might have to even wait for months in order to get the vehicle you want. So we're seeing kind of a shakeup over the last few years as to what a consumer's priorities are. And I think when you look at interest rates being as high as they are, even if they're coming down a little bit and you're starting to see more promotions from automakers, is something in which that basic transportation, that's top of mind again. A lot of flashy stuff, not selling as quickly. People can just go to point A to point B in a reasonable manner.
Really interesting. All right, figuratively and literally kicking the tires on EVs, and then on hybrids, willing to wait, it seems here. It's interesting. One of the first lessons that you learn about cars, and most of them, is that they lose value the second you drive them off the lot, almost instantly here. So getting in a negative equity position, how do you avoid doing that?
Number one is you gotta love that vehicle that you buy, right? It doesn't matter what it is when you see it online. You don't want to fall in love online. This is something in which when you go for a test drive, go for a test drive. Go under conditions that mimic your real life situation. 5 minutes, 10 minutes, that's not enough. You got to drive roads that you drive on a regular basis and think about all the different use cases for it. It's one of those things where, yes, you might like the color or you like certain features within that vehicle, but if there's something, that one thing that nags at you while you're test driving, that could cause you to come back to the market too soon. Some people come back within a matter of weeks or months. We see people have negative equity. They'll come back. The average age is 3 years old. It's like 3.5 years old. So if you got like a 7-year loan, 6-year loan, odds are you have not chipped away enough at that principal amount to kind of be where your trading price is and break even. So really, it is love what you're buying. If you love what you buy and you got a 7-year loan at 0%, fantastic. That doesn't matter. But if you're signing up for like a high APR loan, this matters even more. Remember that the front end of your loan has more of the interest paid towards it. You're not paying as much as the principal. So again, that's another issue, right? You might be making $800 a month payments, but how much of that is going towards the vehicle's value versus just paying the bank?
That's a great point, Ivan. Just lastly, while we have you, and let's go kind of like one step deeper within that and just focus in on electric vehicles. How can people who are going out and, as you were mentioning, trying to be a little bit more diligent about making sure that they're purchasing the right electric vehicle for them, how can they make sure that it's worth it? And is it worth it for most consumers?
Yeah, number one, you got to look at, are you going to go new or are you going to used? The thing is, in the new market, if you qualify for a lease, right, if you have top tier credit and you're going to keep this thing for those 3 years, that's not going to be, hey, I've never had one, I'm just testing the waters. It can be a fantastic deal for you. We're looking at lease prices, monthly payments, only like $600, actually a little bit less than that. Whereas, say, 2 years ago, it was close to $900, $1,000 easily. But there are so many incentives on the new ones, you can get a smoking deal today. Used, it's the same thing. When the new prices on EVs were sky high and people were essentially flipping them in the used market, that's come crashing down. Now you have off rental, you have off lease, you have a ton of supply in that used market. So you're looking at something like $28K for a used EV that might have had a sticker, something closer to $60,000, $70,000. So again, it's one of those things where you can fall into kind of a problematic area if you are not fully sure whether or not this vehicle is for you. The best way with the EV is to go beyond a test drive. I'd even recommend something like renting one for 3 days, 5 days, an entire week. See what your lifestyle is with an EV. You have prior experience, fantastic. If you've ever owned one of those kind of early adopter EVs, even better. You know what to expect. But if you've never had one before, if you're a mainstream consumer who's like waiting for technology to catch up and for things to become easy and convenient, take as long as you can with that decision.
Edmunds Director of Insights, Ivan Drury. Ivan, I'll tell you what, I like your vibe, man. You sound like a person that loves their car, and you can tell our producers what car you drive because you must love it, man. All right, great to have you here with us. Appreciate it.
Cheers.
Cheers. Guys, coming up, millions of Americans have student debt, but the amount that they pay varies from state to state. Find out which residents are shelling out the most each month. That's next on Well. Across the U.S., borrowers owe more than $1.7 trillion in student loans as of the second quarter of 2024. That's according to the Federal Reserve. But there's quite a difference in how much folks are paying each month across all 50 states. Here with a closer look, we've got Chris Lupo, who is the analyst and writer over at Wallet Hub. Great to have you here with us. Chip, excuse me. You know, as Chip, we're thinking about the delta, the difference between how much people are paying in different states. I mean, just how far is that spectrum?
Well, Brad, the range is from the highest is New Hampshire, $229. That's your average monthly student loan payment, and go all the way to the bottom of the list, and that's tied for, like you said, tied for 49th is Arkansas and Mississippi, with an average balance of average monthly payment of $142. So that's quite a range from top to bottom.
Yeah, absolutely. Okay, so as you're thinking about the ability to pay down student loan debts and of course the different strategies that have been talked about, teased, and ultimately gotten tied up in the courts, you know, how has this all impacted the payments and the payment scales that we've seen as well?
Well, it gets more and more difficult. Again, this is all varied by states, and there's a number of factors that come into play between states. Again, some states are just let's sort of pivot a little bit about we're talking here about the monthly amounts, but some states are actually better than others when it comes to managing their student loan debt. So that's a factor. It's not part of this particular study. But I think there are states, regardless of what economic trends, are just traditionally better. State residents are at paying down their student loan debts and not having those loans become delinquent.
And so when you think about the ability that people have and tips for paying off student loan debt faster, what can they tap into?
Okay, now if you if you're already saddled with student loan debt, a number of things you can do. And the obvious one is, of course, create a budget. Analyze your spending, cut out any unnecessary expenses. And I know that's hard, particularly when you're just out of school and you're trying to get your career and your life on track. And just stick to that budget and review it regularly for any kind of changes. Changes in interest rates or any other types of expenses, prices of items go up and down. So you want to be able to make adjustments for that. Boost your income. Consider taking a part-time job or a side hustle, or simply seek a higher paying job. Look at forgiveness programs. A lot of times, and I'll give you an example. My wife is in a doctoral program for a nurse practitioner, and she's taking out substantial student loans. But part of the deal is that if she agrees to work in a rural healthcare setting for 2 years, they'll forgive that debt. You're seeing that in a lot more areas, particularly areas in which it's harder to retain employees, such as nursing or even teaching. Also, check your employer benefits. A lot of companies will reimburse you for tuition, but the catch is, in a lot of cases, you're required to take a field of study that's related to your job. Most companies, the health insurance companies, not likely to pay for you to study art history, something like that. And of course, make your timely payments, not only on your student loans, but on all of your accounts. You avoid late fees and any types of high interest debts if you keep your payments on time and try to pay more above the minimum amount when possible.
Certainly. And Chip, just lastly, while we have you here, student loan debt, the average out is about $38,000, I believe. So all of that considered, if you think about the payments across each state, what type of time frame are we talking about for the average person to be able to pay off their student loans after they've been able to, or have taken on and been saddled with that debt?
Oh, it could take several years depending on your field of study. But for example, let's just take a look at the top 5 here as far as student loan debt. We talked about New Hampshire, Massachusetts, Vermont, Connecticut, New Jersey. Are you seeing a geographic trend here, Brad? These are all Northeast New England area states where cost of living is substantially higher. There are a lot of really good, really expensive, mostly private schools. And the economic opportunities there, cost of living is higher. And then there's opportunities for additional education, professional schools, graduate schools. So the odds of increasing that debt are even higher. So again, it just depends on where you are, but you're talking several years. I mean, I know folks that are in their mid to late 40s who are just now paying off their undergraduate student loan debt.
Wow. Chip Lupo, analyst and writer at Wallet Hub. Chip, thanks so much for taking the time here and for some of the details from the study. Appreciate it.
Anytime, Brad. Thank you so much.
Certainly. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. They'll count you down to and through the market close. You don't want to miss it.